stopping shipments. So we're going to get some type of negative supply shock on production that's going to be inflationary as well. And so the Fed, as we know, data dependent. They need to see the data. It's going to be another few months at least until we see a material slowdown in the economic data, so their hands are going to be tied. That's what I think markets are probably underappreciating, is that those 4 cuts that are being priced in look like recession cuts. That doesn't feel very good if they're delivering 4 cuts, but it's because they're being flat-footed and we're in a recession.
Do you think they're going to deliver 4 cuts?
I think the only way they deliver 4 cuts is in the back half of the year. It's very hard for me to see any cuts before September, to be honest, but when they do come, because they're going to be late, we could very easily get 50 basis point increment cuts, and that could get you to 4.
Mohammed said it earlier on, there are good cuts, there are bad cuts. They don't sound like good cuts, do they?
No, it sounds like the average between people who are pricing in a recession and basically people who think that there's not a need to cut at all. This, to me, is one of the biggest dilemmas. If they are late, how much can they actually stave off some of the damage? And if the damage is done, is that accurately being priced into a market that is rallying almost back to where it was on Liberation Day?
Based on how they've set up their reaction function, based on what we've heard from the chairman, they've committed to being late, haven't they?
I mean, essentially, they need to see the hard data roll over because they've dismissed some of the soft data. And politically, how do they say this is going to send us into recession politically? To Mohammed's point, how is that a positive idea that they want to send politically at a time where they are increasingly under fire?
And speaking of politically, how do they cut now when they're getting jawboned by the president and not look political? They are in a really difficult spot and walking a very fine line.
The optics aren't great going into Wednesday, let's put it that way. You know you're going to get the live feed, the live blog from the White House, just as that news conference starts on Wednesday afternoon.
That's the reason why, and I don't think there are any other analogies to Homer Simpson, but I do think that the idea
disappearing
into the bushes is maybe a desirable outcome.
Someone should ask the chairman about that on Wednesday.
Do you want to be Homer Simpson right now?
I want to disappear into a bush. Sarah Wolf of Morgan Stanley. Sarah, it's good to see you.
Thank you.
Thank you. Sarah mentioned trade. What's going to be happening at the ports? In the next hour, a must-watch conversation, a must-listen. We'll be catching up with the Port of Los Angeles Executive Director, Gene Soroka. He'll be right here in New York City. Look out for that conversation as we count you down to the payrolls report. Reaction from Stephanie Roth of Wolf Research and Jeff Rosenberg of BlackRock. All of that still to come. The third hour of Bloomberg Surveillance. Up next.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The risks are on the downside, but it's a bit early to look for the real negative numbers in payroll.
You've got labor market conditions down, maybe even negative payroll prints in the next couple of months.
There's seasonal factors weighing on the print. It makes sense for it to be below 100.
We're going to still look quite robust, but we expect that then to come off in the second half.
The unemployment picture is still going to hang in there.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bell 90 minutes away. The third hour of Bloomberg Surveillance starts right now, focused on one thing, the payrolls report, 30 minutes away and just around the corner. Your scores going into that look like this. Equity futures on the S&P, firmer by 1/3 of 1%, looking to build on an 8-day winning streak to extend the longest daily winning streak of the year so far to day 9. Day 9, the longest in 21 years. In the bond market, your scores look like this. Yields this morning on a 10-year, just about unchanged, 422. At the front end, 370. The number we're looking for later on this morning, this hour, 138K, the median estimate in our survey.
And the key question is, how much does it ultimately matter? Mohamed El-Erian has talked about, it talks about where we have been from in terms of the momentum in the U.S. economy. A larger question is, how quickly can we possibly see the pain that has maybe been implemented on the economy from the tariff announcements? But right now, for a data-dependent Fed, how do we interpret data that is so out of date so as to be potentially irrelevant?
You've got all this potential tension playing out right now. You can feel the tug of war. On the one hand, the potential damage to the economy done by the policies announced in the last month. On the other hand, the potential for deals. And that's what we're talking about this morning, the optimism for talks between the U.S. and China.
And this is actually more important, I think, to the market than the random number generator people will call it when it comes to the jobs number later at 8:30. The fact of the matter is we finally have China saying something officially from the Chinese Commerce Ministry saying the U.S. recently sent us messages. We are evaluating those messages, which means now this sets up the start of this potential negotiation.
Do you put more weight on the talks or more weight on the data later this morning?
Probably the talks, because the data is backward-looking and the talks signal what is coming down the pike. That said, is the signal maybe heard a little bit too loudly in terms of what talks signify? It's not going to be necessarily removing all of potential tariffs. And so there's a tug of war here. How much damage is being done as these talks continue and as companies still don't have a compass of exactly what the road ahead looks like?
That sets up this morning. Coming up over the next 60 minutes or so, we'll catch up with Ulrika Hoffman-Bocciardi of UBS, with stocks extending this week's winning streak. Gene Soroka of the Port of Los Angeles as tariffs take a major toll on shipping, and Stephanie Roth of Wolfe Research reacting to this morning's payrolls report. We begin this out with stocks rising as the US and China look to position for trade talks. Ulrika Hoffman-Bocciardi of UBS writing, "We believe we are past peak uncertainty. The existence of a Trump put reduces the probability of severe downside scenarios." Ulrika joins us now for more. Ulrika, good morning. It's good to see you.
Good to see you,
The
Jonathan.
potential for a deal. What kind of deal are you looking for?
Well, first of all, maybe just to set the stage, the uncertainty tax on companies is still very high. We have seen maybe better than feared Q2 guidance, but when we look at full year guidance for companies, a lot of companies pulled guidance, a lot of companies issued split guidance, very reminiscent of COVID-19. And when we look at policy uncertainty, it is very close to COVID-19 levels. So the trade talks have to result in some material outcomes. That's our view. Ultimately, we think that economic rationality is going to prevail. If you're in a situation where you're running a debt to GDP ratio of over 120%, the one medicine that will cure this is high nominal growth. So ultimately, we think that the trade talks will result in more constructive deals, more selective tariff deals, and also lower effective tariff rates ultimately.
I'm pleased you mentioned the COVID comparison, because one thing we said around the table earlier on this week is that the biggest difference now is that the president already has the vaccine and he can switch the virus on and off whenever he likes. He can come out and say deal, exemptions, whatever he likes at any point on social media. Your confidence in the Trump put at the moment, I want to understand how strong that confidence is. If we have a weak number this morning, are you willing to ignore it?
Yeah, I think the market is looking ahead right now. And we turned constructive on US equities, 15% below the peak, for two reasons. One, the Trump put at -20. That was the pivot on the tariff side. And then we also feel that there is a Fed put a little lower than 2018, maybe around 25%. We have now higher inflationary pressures because of tariffs and also the weaker dollar. But ultimately, we see these two puts with different strikes that gave us conviction that the downside is more limited. And then there was such negative sentiment positioning against an upside of more constructive trade negotiations, better than feared Q1 earnings. And then ultimately, I think what we've seen also in the IMF meetings last week, a pivot in narrative now towards deregulation and also tax cuts. So these three upside triggers made us believe that the risk reward at -15% from peak was a pretty good one.
This is a Fed that is committed to being too late, as John was mentioning earlier. And there's a real question about, even though there is a Fed put at some level, it is going to come too late. Pretty much everyone seems to be saying it is too soon to see the real damage in these payrolls reports. So how do you square that kind of idea with this idea that equities are rallying on the idea that there will be a softening in tone, at least from some of the worst case scenarios around trade?
Yeah, look, I mean, I think from here we are now bounced quite a bit off the lows. There might not be a lot of near-term upside, but I think over the next 6 to 12 months, we can see many more positive catalysts emerge. Again, once we have deals, India seems to be very close, as Secretary Bessent said just a few days ago. China more constructive this morning. So as we are seeing deals materialize, I think the market will pivot more towards growth, wanting to see continued growth, strong earnings in the US. We see the AI momentum continuing. So I think we may be over the peak of concerns, and the Fed put the strike may be too low to really matter at that point.
So I want to go back to what you call the Trump put.
Yeah.
So did I hear correctly that the market believes in the Trump put, but the corporate sector is somewhat more hesitant to believe in the Trump put in a world in which they face not only uncertainty, residual uncertainty, but they also face a Swiss cheese approach to tariff policy. And Swiss cheese tariff landscape, very tricky to navigate for a company. So am I right in saying you're seeing somewhat of an asymmetry between what the market believes in terms of the Trump put and what the corporate sector believes in?
So I think there is a CEO put as well, because I think the more the CEOs comment on the economic potential aftermath of these tariffs, right, the more the urgency of the administration to move. And I think we have seen this with UPS announcing the layoffs. So I think that is a positive thing, that actually the CEOs are flagging the economic risks from the current tariff uncertainty, and will actually, I think, make the administration move more quickly. So yes, there is an asymmetry, but I think the reason that the CEOs are so cautious on the economic environment is a good thing to catalyze ultimate constructive trade deals.
Does it tend to catalyze selective tariffs, your word, selective tariffs, which I translate as Swiss cheese, okay? Certain countries, certain products, etc., and then you have to spend a tremendous amount of time figuring out, are your supply chains consistent with this? Does it encourage what you call selective tariff concession, or does it encourage a general tariff agreement?
I hope it's going to be a combination of the two, but we have seen this in 1819, that ultimately, even with China, it turned out to be very selective, that certain companies were exempted, that certain products were exempted. Because ultimately, if you can't substitute a good in the US, you should not impose high tariffs. So I think that is a constructive economic move. And while it will maybe take a little bit longer, I think if we see signals that we are moving in that direction, that's a very positive thing for US equities.
It's difficult to process all of this. We had a story on a Bloomberg terminal today, which I suggest everyone should go and read, about exemptions without declaring exemptions in China. They're not actually prosecuting what they said they would with regards to tariffs.
And anecdotally, I've been hearing from sources that this is actually happening. The imports will come into China. They will not have that 125% tariff, but China will not say it out loud. They are not being transparent about it, but they're not exactly putting the tariff on. But why? The China Beige Book was out yesterday, and they talked about how manufacturing and factory activity was down in China.
To pair this idea with the asymmetry, there is a feeling in markets that if you're having talks, all of a sudden you could end up with something that is a much more benign outlook for companies. But to Mohammed's point, how do companies make capital expenditure plans? How do companies come up with longer-term buying sprees if they don't have a sense of what the Swiss cheese is going to end up looking like, and if there isn't some sort of cohesive put or strike price that potentially could get engaged with?
You wait, and if you're waiting, are you hiring? And that's the question we're trying to answer in about 20 minutes' time when we get the payrolls report. Ulrika, we've got to leave it there. It's good to see you. Thanks for being here. Ulrika Hoffman-Bachari there of UBS. The payrolls report is just around the corner. Equity futures doing okay, up by 0.4%. With an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. Shares of video game studio Take-Two are plunging 9% in the pre-market after announcing the launch of its flagship upcoming game, Grand Theft Auto 6, will be delayed until next year. The company didn't specify the reason for the delay, but said in a statement it supports its label Rockstar Games' decision to take time to realize its creative vision. Meanwhile, Temu is shifting to a local fulfillment model, only selling goods from local U.S. merchants to American consumers. The move allows the Chinese-owned company to sidestep tariffs and is a change from its original model centered around selling Americans cheap Chinese goods. And in sports, the Knicks are advancing to the second round of the NBA playoffs after beating the Detroit Pistons. Elsewhere, the Clippers and Nuggets are headed for a decisive Game 7 after LA tied up the series. And in hockey, the Toronto Maple Leafs and Vegas Golden Knights and Edmonton Oilers are all heading to the second round of the Stanley Cup playoffs. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, the Morning Calls Plus. This conversation right here, a must-watch. Gene Soroka of the Port of Los Angeles as shipping traffic plummets. That conversation up next.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The opening bounce 1 hour and about 16 minutes away. The payrolls report is just around the corner. That drops in about 10 minutes' time. At 8:30 Eastern time, we'll get payrolls. The estimate in our survey, 138K. The equity market looks like this. Your price action positive by 0.4% on the NASDAQ, up by 0.3. That's the market price action. Here are your morning calls with just one stock in focus. It's Apple. First up, Rosenblatt downgrading the tech giant to neutral, saying it needs an exciting new product to reinvigorate growth. The stock is down by more than 3%. Your second call from Bank of America, cutting its price target to 235, expecting further deterioration beyond the June quarter. And your third and final call from the team at Jefferies, downgrading Apple to underperform, saying tariff impacts will expand over time and create more earnings downside. That name's softer going into the opening bell. Let's stick with trade. Gene Soroka of the Port of Los Angeles bracing for a plummet in shipping volume next week, writing, quote, with 145% tariffs on goods from China, products cost 2.5 times more than last month. Many large importers here in the US have hit the pause button on cargo coming from China. Gene joins us now for more. Gene, good morning. Good to see you.
Good to see you, John.
Just describe for us, let's take a beat, really frame it for us, how much volume has just dropped off in the last few weeks.
Yeah, about a third of the import volume, which means give or take about 50,000 20-foot equivalent units gone off the arrivals coming in next week.
From next week is when you expect to see this really hit.
That's correct, and that matches up. The announcement's back on April 2nd, then on April 8th, a little bit of a change on everybody, ex-China, Mexico, Canada, and those arrivals are coming at us this weekend.
We'll, of course, dedicate time to your port, but I'm just wondering how you're anticipating this rolls and ripples through the economy from here, how it hits trucking, when this turns up on the shelf. What's the distance, the time, from when you see a drop-off in volume and when we, as consumers, see the shortages?
Right, so CEOs are telling me, hit the pause button, right? I'm not going to import anymore at these kind of prices. Let's wait and see. I don't know if it's going to be 2 hours, 2 days, or 2 weeks till I get some clarity. Then, hiring. Off the table for right now. Capital investment, pause. And the retailers are telling me that realistically, with even the 10%, I'm going to have to pass it on to the consumers.
So how much is this really coming from all over? It's not just about China. This is about really global trade coming to a standstill until there is a much greater degree of certainty and a much lower tariff rate than even the baseline that's been put out there.
Yeah, when I was last with you all, Lisa, I said global trade's going to slow, economies will follow, and that's exactly what we're seeing. Back in November, so many of us were wringing our hands about 4% inflation. We've just added 10 percentage points to imports coming out of Southeast Asia for our port, and these unbelievable numbers out of China.
How much are you going to see a real decline in dock workers if this goes on?
Yeah, this is the question. So the trucker hauling 4 or 5 containers today, next week, she probably hauls 2 or 3. The dock workers are no longer going to see overtime and double shifts. They're going to probably work less than a traditional work week, starting right off the bat. Every 4 containers mean a job. So when we start dialing this back, it's less job opportunities.
And what happens if we get a deal?
If we get a deal, it's going to take about a month. Let me walk you through that real quick. About 2 weeks to get the ships repositioned around these major ports, from Qingdao to Shanghai to Xiamen, load up all those containers, and then another 2 weeks to steam across the Pacific to get to us. This is important because now we're talking about spring and summer fashion. So we're kind of at a crux here that we've got to have something pretty quick.
And back to school, which is, I think, very critical when it comes to political pushback for this administration. We have a story out, it was anecdotal reporting as well. We've heard about China quietly starting to exempt about a quarter of U.S. imports. Are any U.S. importers exempting Chinese tariffs? Is there a way to get around the 145%?
Not really. There may be some exceptions, Anne-Marie, maybe a little bit going north or south of us, but realistically speaking, nobody is out there talking a lot about, hey, I got a better deal coming out of China right now.
The Flexport CEO joined us earlier in the week, and he said ocean freight is down 60% from China. When do we see 100%?
Good question. It depends on how long this goes. We heard the reports overnight through Bloomberg that the folks in China are thinking about talking. What does that mean? Okay, great, but we've got to get a move on here. The other thing is that retailers are saying we've got about 5 to 7 weeks of normal inventory in the country right now. Then we start to see spot shortages if it goes on much beyond this.
So, Gene, you're giving us a really good insight into what's going on. And you said corporate are pressing the pause button on several things, and you listed them. I want to ask you, what does it take to press the play button again? Is it simply good news on the trade negotiation side, or will they want something firmer than that? What is it that it takes the CEO of the different people you talk to press play with confidence?
Yeah, Mohammed, I think it's going to be much more than just talk. It's going to have to be something tangible. And when you're starting at 145% tariff, it's not cutting it in half or cutting it by 2/3. It's getting something realistic, because as was just said by Anne-Marie, this is going to start impacting some of these important seasonal goods. And if not, China pivoting to other places is not a transactional part of the business.
So you rightly said, and we had the pandemic as a stark reminder, that this is not an on-off light switch, that the ships are in the wrong place, the containers, etc. How long does it take to simply get everything back working in an orderly fashion?
Yeah, it'll take a couple weeks just on the vessel deployment side, the waterborne architecture of this. And then you got to load up all this product and get it back over here to the U.S. So 4 weeks in between hitting the play button, as you say, and getting the product to L.A. Then we've got to get it to 15 major hubs.
In your planning, how long to putting the play button? So we have 4 weeks after that. How long?
It really depends, and I can't see that clearly right now, because the talk of getting to the table is still just that. And we're not really seeing any movement from either side. And the China guys are telling me, I had worked there for about 4.5 years, still maintain great business contacts throughout the country. What they're telling me is that factories are really dormant right now, but the government's helping out those workers. So can they wait a little while? I think they can.
The market's treating this as on-off, on-off. The physical world, shipping, what we're talking about right now, it's not the same. It's not the same at all.
What I'm struck by is how much COVID is a corollary, and how long it took and the distortions that really were involved. And that people are looking at this as the similar type of disruption, at least when you talk about withdrawals. But I wonder, from a shipping perspective, how much this is actually a similar feeling to what it was in March of 2020 versus something vastly different in terms of both the on-off switch as well as the framework for how to understand global trade.
Gene, what do you think? What would you say to that?
I think the similarity ends with a pretty quick drop-off, but we saw this coming where COVID was a lot different. And then when we figured out about curbside pickup and online buying, and all of a sudden we started that swing in imports again, we just don't know when that's going to happen this time, because it depends on people getting together and talking. So I think the similarities are relatively limited, but now it's, what do you do for the worker? What do you do for the planning? And what do you do for these milestones coming up on various inventory and seasonal products?
Tell us about that. What do you do? I assume that overtime just ceases, that ends. What happens to the dock worker?
Right. For us, the dock worker is got to get back out on those terminals and work on the preventative maintenance and repair of equipment, because we know we're going to get a surge again. You've had a pretty hot run for 5 years. This equipment has really been going 24/7. So let's get it back into a state of good repair. Let's get the terminals in good shape, because when that surge comes, we'll be able to see it 40 days before that ship arrives in Los Angeles, giving us plenty of time to plan the skilled workforce, the equipment, and the land. Now is the time to do all that preparation that you normally don't have a chance to do. Take advantage of it.
When they go into these negotiations, what's the rate that gets what you're describing now? Ships back running, dock workers back at the port. What's the rate that'll start to reestablish that?
I think on the 10% tariffs for everybody else, it's got to get lower than that. And on China, you got to start talking about what it really means. The American farmer is getting decimated right now with the retaliatory tariffs. That bread basket in the Central Valley of California is really hurting. So we've got to talk specifics. But at the same time, protect American jobs, American interests. Rules-based trade are key. but we've got to do it a little bit more strategic.
Well, this is why Brooke Rollins was saying that potentially there's going to be a bailout for farmers, which we saw in the first Trump administration. But Trump promised 10% tariffing around the United States, 60% on China. What if they end up there?
It's going to change. It's going to change the difference in the world order. I think China goes out and finds other customers. And they said this week in the headlines, other people have money too. This will be very different. And the cost of our products at the store and online goes up. Unequivocally, it's inflationary.
We're less than 7 minutes away from this payrolls report, and it probably won't reflect a lot of what you're talking about. That's a very slow-moving type of ship, literally coming or not coming toward the United States. But you do talk with these dock workers. You do talk with the truckers. You talk with people who are in the front lines of potentially feeling some of this first. How much are they pulling back? How much are they girding for a whole host of uncertainty? How much have they changed their behavior and seem different to you, just in an anecdotal level?
They're scared. Plain and simple. Not having as much work to do, not having the job opportunities that exist, the warehousing folks included in that group of three, they're really concerned. And these are working class people, good middle class jobs, putting food on the table, kids through college. This is a huge concern. What does it mean next?
Do they also worry about air freight? Do they also worry about companies will start thinking we've got to have a better balance in the way we bring things over?
Yeah, I just had lunch with John Ackerman, who runs LAX and the Van Nuys Airport. His air freight numbers are plummeting. Passenger numbers are of real concern. We've seen the guidance from several of our domestic airlines this week as well.
Has the White House been in touch? Have they spoken to you?
I'm on calls with the USTR. In fact, we'll have another one today. And we've got to advance those conversations. And what I appreciate here with you all every time I come on is amplifying the ground truth of what's happening. Not taking sides. I've got to be apolitical. But now we're starting to see the impact to the workforce. We're going to see the impact on inventory levels, manufacturing parts and components, and these agriculture exports are really, really in play right now.
Gene, appreciate your time.
Good to see you.
Looking forward to catching up again in the future. Gene Soroka there of the Port of Los Angeles, a clinic on what is happening right now. Not an opinion, what is happening right now.
And what's happening is what's not happening, which is those ships are not on the seas coming over here from China, from Europe, from Asia, just more broadly. And that is going to create a problem if it isn't necessarily remedied. There is this question, though, about what this means for the workforce that is most directly affected with this, with respect to docking, with respect to trucking, with respect to railroads.
We've got to talk about a payrolls report in just a moment. It's 5 minutes away. The estimate in our survey, 138K. The previous figure, 228. Tariffs in focus. Policy volatility down in Washington, D.C. Is it too early to expect to see it in these numbers this morning? Your payrolls report just around the corner. Reaction with Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The jobs report is 25 seconds away, and going into it, your scores look like this. Equity futures positive by 0.5% on the S&P on an 8-day winning streak coming into Friday, the longest of the year so far. We're looking to make this day 9, and the fate of this market could be in the hands of one man, the President of the United States, and this data. The jobs report just around the corner. In the bond market, the 10-year yield shaping up as follows. Your 10-year, 4.2269. With the payrolls report, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, American exceptionalism continues. 177,000 jobs created last month, 228. That's revised down to 185. So basically, we come out just about even in terms of the month-to-month numbers. The private payrolls were up 167,000. Manufacturing lost 1,000 jobs. The forecast was for 5,000. Unemployment stays at 4.2%. I'll check on the 3-digit number in just a second. Labor force participation ticks up 62.6%. And U6 falls to 7.8 from 7.9%. Average hourly earnings come in a little weaker than anticipated, 0.2% for the month, 3.8%, same as last month for the year over year. And here's an interesting one, 34.3 average weekly hours, 34.2 in the prior couple of months. And if companies were going to be cutting back, they'd usually cut back on hours before they cut back on people. This month, they did neither. Let me check into the rest of it. You know, and John, the whisper number 120, Wall Street was leaning towards a weak report. How are they reacting now?
The risk was a downside surprise, the reality an upside surprise. And Mike, I can tell you, good news is apparently good news. Equity futures session highs up by 0.9% on the S&P 500. On the Russell, we're up by 1.7 in the bond market, unlocking high yields at the front end of the curve. Yields up by 6 basis points on 2s to 376. On a 10-year, up by 5 to 426.76. In foreign exchange, a touch of dollar strength relative to where we were. So euro dollar rolls over, Lisa, to 113.14.
Yeah, you know, it's interesting to me that the equity market is maybe taking more of a signal because you're seeing yields pop at the front end, but not as much as you would expect if suddenly this took all rate cuts off the table. It's hard to know how much of the strength to extrapolate out, but I think Mohammed nailed it earlier when he said it really gives a sense of how much momentum there is coming in. And to Mike's point, there is still American exceptionalism, at least expressed as in April numbers in terms of how much of an upside surprise this was.
Mohammed nailed it, Lisa. I'm pleased you brought it up. The degree of resilience that this economy has going into what is a policy shock. And for the moment, at least, you're not seeing that weakness in the economic data at the surface level. Mike, I want to bring you back in for the details. What do you see beneath the surface?
Well, it looks at this point like we're seeing an unemployment rate, and this is the one that the Fed really cares about, an unemployment rate that is basically because we're hiring. 436,000 people were hired during the month, according to the household survey, while only 82,000 were listed as unemployed. The labor force rose by 518,000. So a lot of people coming in to look for jobs at a time when we were told companies weren't hiring. So that is kind of interesting. Construction, 11,000 jobs, which is reasonable. This is the time of the year when you would anticipate more construction jobs being added, but there was this fear that we wouldn't be able to find them because of the deportations and border closures. So some interesting news there as well.
So what Mike said just now is really important. It's not just about the demand side, it's also about the supply side. This is a good report all around in terms of demand for labor, supply for labor, and muted earnings growth. So this is something that, as we just heard, confirms residual economic exceptionalism. It says we have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
Do you have confidence we'll see a repeat report next month?
No, I don't. I think the world did take a shock, a significant shock, so we're going to see. But it's important, you know, whenever you go into a tricky situation, you want to have momentum. Momentum gives you a certain amount of resilience.
Mike McKee, stay close. I want to bring in Stephanie Roth of Wolf Research into the conversation. Stephanie, good morning.
Good morning.
Your reaction to this one, please.
It was a strong one. Granted, we had some downward revisions to the prior month, but the net trend is pretty strong. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months. And if we don't get a significant downward shift in the tariff rate from China, then things like the strength in transportation and warehousing is gonna very much shut off.
If I were a pessimist, not that I am, but if I were a pessimist, if I wanted to look at the negative side of this, I would say it gives the Fed no excuse to even come close to cutting rates, and that potentially they have no reason to signal that they are concerned about a true weakening in the economy that is politically fraught as well as not represented in the data. How much does that increase the backside of the year and the potential weakness that you could see down the line if the Fed is disinclined to really make any movement?
I think that's right. There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon. At this point, the economy is fine. They have to be reacting to the unemployment rate, which is kind of steady at the 4.2. And they're concerned about the inflation backdrop, but for now, they just have to sit and wait. They have to wait until they see an actual rise in the unemployment rate before they can make notable changes. And at this point, the economy is okay, and consumption has been okay up until this point, so it's just wait and see for the Fed.
On the flip side, to Mohammed's point, and this is the reason why this is such a mentally twisting kind of moment, you could say, well, the economy has a lot of momentum. We're coming into this very strong. We might get something of a hit, but it might be a disinflationary shock, if anything, which might help out the Fed. And then we end up back in the soft landing type of narrative. How much does this give you confidence that we still have that potential, even amid all of the uncertainty?
So base case at this point is the economy can avert a recession, although barely. If policymakers actually start to change their tune a little bit, which we are starting to see out of Washington to some extent, and the headlines around potentially some conversations with China certainly helps. So base case is that they'll change their tune a little bit. If we end up with 10% across the board tariffs and tariffs on China of 50%, maybe 40%, then the economy can be okay this year. You just have a 1% or so shock on the economy. But having the solid momentum heading into this certainly does help.
How much time do they have to change their tune, as you say, to avoid the most difficult economic damage?
We have a couple of weeks.
Weeks, not months.
We have weeks, not months. I was just talking to the guests from the Port of LA just before this, and they were discussing the amount of time, especially smaller retailers have. They don't have these big warehouses. They have a couple of weeks. Take a bike shop, for example. They have just a couple weeks worth of inventory, and they wait for the next shipment. And if the shipments aren't coming in, it's going to become a problem. They're going to have to just shut down because they'll have 1 or 2 bikes left for sale.
These are the empty shelves that people worry about. If you are just joining us 7 minutes ago, we just got the payrolls report. It came in at 177. The median estimate in our survey was 138. The unemployment rate expected to hold at 4.2%, and it did, 4.2%. They're the two headline numbers we often think about. Mike McKee, you look beyond the headlines. Sum it up for us. If you just missed it, what did you miss?
Well, right now, what I'm seeing is some impacts, it looks like, in the tariff areas, or to-be tariffed areas. Computers lost, construction lost 4,000 jobs. Semiconductors lost 1,100. Primary metal jobs were down by 100. Apparel jobs down by 300. And government workers down by 9,000. Leave out the Postal Service, but they got some DOGE cuts too, and you have 8,500. So you are seeing some impacts from the administration's moves already. In terms of the unemployment rate actually rises by a few basis points points. The 3 digits is 4.187 from 4.152. So we came very close to getting a 4.3 handle, but it didn't move. And as you're talking about, unless the Fed sees the unemployment rate moving, they're not moving.
The equity bulls getting everything they want this morning, Lisa. A better jobs report, the potential for talks between the US and China, and potentially a 9th consecutive day of gains on the S&P.
I guess I'm trying to understand, if you flip this on its head and you talk about real strength in the economy and you talk about the potential for a deal, are we underestimating the inflationary pressure? Are we underestimating just how much growth there is that potentially is not being accounted for by the Fed or by the rest of the universe? I don't know. I'm just wondering, maybe people were saying there's a difference between the bond market and the stock market, and the bond market's so smart and it's always right. Maybe the stock market was right. And all of a sudden you need to reprice things on the other end.
Pretzels, is that what we're making this morning? Look, let me put it this way. Whether this number was weak or strong, the risk was always that we extrapolated it out. The policy shock that we've had in the last month is so large that the distortions you'll see in the data, not just this month, the month after that, the month after that, just to go back to Gene Soroka again at the Port of LA, he's telling you, he's basically telling you what things look like now and how long it'll take to get things back to normal, even if you strike a deal tomorrow.
Which is the reason why, if you take a look at the 2-year yield, it's almost completely retraced back to where it was before this print, because people are looking through this. They're saying this is not what we're going to experience in the upcoming months.
Jeff Rosenberg of BlackRock jumps into the conversation now. Jeff, welcome to the program. We want your thoughts on where things are, how we're set up, going into the opening bell, 50 minutes away.
Yeah, first point here, just agree with Mohammed's take that this is about where is the economy coming into the shock, and this is a good report, and that's important. You've got more resilience when you're coming to a shock from a place of strength. You look through the report across payrolls, across earnings, hours worked. It's all strong. Now that's the first point. The second point is, unfortunately, it's really less relevant to the go forward, because this is kind of, yes, it's our first hard data, but it's really pre the tariff shock. And as we're discussing that tariff shock and the size and the scope and the amount of exemptions, that's evolving, but none of this data really reflects the impact of the shock, and we'll have to see that data show up. And that's the third point here, is that the Fed, and they're going to have to wait, and they're going to have to wait until they see any kind of impact in terms of a rise in the unemployment rate. And until you see that, you're not going to really see any kind of expectations of Fed intervention. And as the other guest was saying, it's very hard for them to be preemptive and to go to forecast dependence. This is data dependence. And this is lagging data, and so that will be, really one of the last things to show up as we talk about that in months ahead.
Jeff, if I may push you a little bit on what you just said. So how are you navigating all these serious puzzles, soft data versus hard data? What about the sequencing? You hear some people say, yeah, we're going to slow down, but don't worry, there's deregulation, there's tax cuts coming, we're going to bounce right up. There's so many issues right there that people are debating in a very genuine manner. When you put it all together, when you look at the growth rate for the US, the IMF last week took it down from 2.7 to 1.8 for this year. A lot of people thought they would go further down. They will go more towards 1%. Where's BlackRock right now in terms of how all this nets out in terms of growth for the US this year?
We have a very broad, diversified group of investors. So BlackRock as a totality has a lot of different investors with a lot of different points of view. I'll tell you, my point of view on this is that we've had a shock. Is the shock going to be as big as, the immediate market reaction in the post-Liberation Day announcements? No, you see the walk back from that. But the shock has affected outcomes. And the uncertainty about how big that will be, yes, we've probably cut off the tail because the administration's response, the concern about financial markets and the negative reception, the concern from the real economy participants and the real effects that these very initial tariff policies we're having, we're seeing that walked back. However, you still have the damage to be seen, and that means likely some degree of slowdown. And even if the tariff rates are much reduced from the initial proposal, you're still talking about this kind of uncertainty. The Fed brought back into the language a transitory effect on inflation from the one-time tariff increase. The big question will be, in an environment that is much more used to price increases, what are the second-order effects on inflation and inflation expectations? As you see that, what should be a one-time effect, is it really a one-time effect? And those will be, the big focus. I think, in our outlook, the vulnerability here is the markets have kind of repriced very quickly any kind of risk premium. You see it in the round trip in equities, you see it in the round trip in high yield spreads. So there's not a lot of margin for safety with respect to market pricing. So for us, that's meant a little bit more of taking the opportunity as the market has kind of moved to very quickly price in a more optimistic take, to take a little more defensive positioning in our portfolio.
Jeff, what does defensive positioning actually look like? What does that mean in today's market?
Yeah, for us, we run a liquid alternative fund that is positioned as an alternative diversifier. So when we're thinking about like our upside downside, we're going to be much more sensitive to downside protection. And so defensiveness means up in quality, for example, in our credit space. It means reducing some of the more equity sensitive areas within the portfolio that have the highest kind of beta, highest market reaction to economic sensitivity, to the potential that tariffs actually end up leading to a much more adverse outcome for the economy. And it means on the duration side, on the interest rate side, because the flip side of the tariff piece for growth is, as I was just talking about, the kind of inflation and inflation uncertainty. And that leads to a very different kind of bond market reaction where you could have a twist steepening where, if the Fed preferences growth over inflation, in a stagflationary shock, you may have the back end, longer maturity rates not doing what you expect them to do. And so that means kind of shortening our, what we call key rate duration. Where are we getting our exposures for the diversification? Looking much more to the front end of the curve than historically you would have thought, hey, the back end is really the best place. In today's environment, I think the back end is much more vulnerable, and a stagflationary kind of outcome really changes how you think about defensive positioning in fixed income portfolios.
We were talking to Priya Misra earlier of JP Morgan Asset Management, and she said that 30-year treasuries were the risk asset right now and doesn't really want to go there. Do you feel the same?
Yeah, it's a similar viewpoint. Yeah, you got to be careful because there are a lot of cross currents. There's a lot of potential for policy intervention and some other changes. And you have to also be careful that market positioning, as Priya's talking about, it's a very popular kind of crowded viewpoint that the back end is vulnerable. That being said, I think the base case is, and we've seen it here, we saw it in the post-tariff announcement, a big curve steepening, that you do have the potential here. It used to be in the zero interest rate environment post-GFC, flight to quality was a curve flattener. You wanted to own the 30-year. In an earlier era, long before the GFC, we used to think flight to quality was a curve steepener, and I think we're back into that kind of environment. That makes it a little bit challenging for investors who are kind of cash limited because you don't get the same kind of return for a dollar investment. It means you need a little bit more flexibility in your portfolio toolkit to use things like futures and leverage to equate your diversification irrespective of where you are on the yield curve. And a little bit more flexibility in the toolkit allows investors like ourselves to be able to do that.
Hey, Jeff. Thanks for dropping by. Jeff Rosenberg there of BlackRock on the latest in this market. The latest on the jobs market, 177K, an upside surprise on the jobs report with an industry breakdown. Mike McKee joins us now with more. Mike, what do you got?
Well, John, looking at some of the areas where you would think the tariffs would have an impact, at least they might at some point. They haven't yet today. Retailers lost 1.8 thousand jobs, but building materials, this is the time of year when people would hire more for building materials in garden centers. They were up by 2.7%, by 2,700. And as I mentioned, construction workers were up. Healthcare and social workers, this is the category that would include some of the workers that would be laid off in terms of contractors or some of the aid programs that the administration has slashed, but they were up by 7,600. So we're still seeing people getting hired into areas in which you'd think there would be job cuts or that they may be coming at some point, but we haven't gotten there yet. Only 2,000 people listed as job losers. this past month. So right now, it looks like the economy is still, or the labor market at least, is still pretty strong.
Mike McKee, thank you. Breaking down the labor market for us this morning, breaking down the commentary from the White House. Anne-Marie, the president, with a few things to say.
A few things to say. He's talking about gasoline. He's saying it just broke $1.98. I'm actually looking at what the national average is. It's just above $3. He's talking about energy down, employment strong, and get to the punchline, of course. He's saying this is a perfect moment for the Fed chair, Jay Powell, to lower interest rates. The jawboning, Jonathan, continues.
Stephanie, is it the perfect time for Jay Powell to lower interest rates?
It is not the perfect time. It's the opposite. The economy is running okay right now. They don't want to get ahead of this. They're going to have to just wait and see what the impact is from an employment perspective and then an inflation perspective, by the way. Inflation could be running up towards 4%.
Stephanie Roth of Wolfe Research is going to stick with us alongside Mohamed Al-Arian. The whole team is going to sit around the table to break down this jobs report with us. Just for now, though, I want to get you some top stories from elsewhere with some Bloomberg briefs. Where's Yahara Hacker? Say, Yahara.
Hi, John. Recapping that data, April payrolls topping forecast. The U.S. added 177,000 jobs, and the unemployment rate held steady at 4.2%. Looking under the hood, manufacturing jobs fell by 1,000, but transportation and warehousing added 29,000. Wages are also up year over year by 3.8%, outpacing consumer prices. We love to see that. Next up, we have China saying it's assessing the possibility of trade talks with the U.S. It's the first sign since President Trump hiked tariffs last month that negotiations could begin between the two sides. Still, as a condition to negotiations, the ministry asked the U.S. to show sincerity towards China by canceling tariffs on its goods. And the White House is set to release the first budget proposal of President Trump's second term. According to sources, the so-called skinny budget will call for $557 billion in non-defense spending, a nearly 23% drop from current levels. Meanwhile, national security funding would rise to $1.01 trillion, which is a 13% increase from existing levels. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll break down this jobs report, this market, and look ahead to the week ahead. From New York, this is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening bout just around the corner. Equity futures. Welcome to the program. Looking ahead into the weekend and through to next week. Coming up a little bit later, you'll get data, durable goods and factory orders. Monday, ISM services. Tuesday, the trade balance. Wednesday, a Federal Reserve rate decision and news conference with Chairman Powell. And then on Thursday, another round of claims and a Bank of England rate decision. With us around the table, Mohammed Al-Arian and Stephanie Roth. Stephanie, what are you looking for in the data into next week?
Yeah, I mean, so for certainly, well, let's just comment on today is, yeah, the economy is solid right now, but heading into the next couple of months, it's going to take a big turn. And by the way, one thing we didn't talk about yet was the foreign-born numbers within the payrolls print was a little bit softer. So this is something to keep an eye on in the next couple of months, is to the extent to which immigration is also having a negative impact on the labor market.
Mohammed, is that your worry as well, that in the next few months this data is going to weaken?
I do worry about the supply side. I don't think we pay enough attention to the supply side. And Stephanie is absolutely right. You should look at the various disaggregated data that give you some signal. You know, broadly, can I give a suggestion for the graphic you just showed?
Please do. What would you change?
You should have underneath, going across every single day, tariff negotiations. Because I suspect that you will be talking about that layer as much as you'll be talking about what's above.
Can you speak to the graphics department? Lisa, can we make that change next week?
So. Tariff talks will happen. Tariff talks may happen.
We can have
maybe
that run across the bottom of the screen.
It will happen. You think so?
That could run across the bottom, couldn't it?
Well, this is the issue, right? So how do you interpret these numbers and how do you extrapolate them forward? And you pair that with what President Trump just tweeted or truthed or whatever you want to say, which is no inflation, lower rates. Are we trying to get ahead of something? Are we just reflecting what actually we're seeing? How is the administration's response to the incoming economic data going to cloud the equation on all sides when people still believe there is a Trump put?
I love the idea of a tariff ticker because I feel like I could help with it. Two things to watch out for today. Japan, they're coming out and they're saying the U.S. is reluctant on a number of issues that they need to see to get a deal. And of course, China. The driving force of all of this, when you talk about chips being backed up, China's very important. Maybe they're ready to come to the table.
Session highs in the equity market up by more than 1% on the S&P. After the commercial break, we'll be right here. We'll be catching up with the administration, reacting to the payrolls report. Stephen Myron, the chairman of the Council of Economic Advisors.
Welcome back to another special Mutual Madrid Open update for Bloomberg TV and Radio from Tennis Channel. Coco Gauff reached the championship match in the Spanish capital for the first time after she took out defending champ Iga Swiatek in straight sets. She'll face world number 1 Aryna Sabalenka for the title after she was just too good for Alina Svitolina. Coco leads their head-to-head 5-4 going into Saturday's showdown.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it, on the China Show,
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
don't miss the China Show live every weekday. The opening bell 30 minutes away, and going into that opening bell, equity futures near session highs up by 1.2% on the S&P, on the Nasdaq 100 up by more than 1 full percentage point. Sneak peek of the bond market, 2-year, 10-year, 30-year yields higher across the curve, up by 7 basis points on a 10-year. Lisa, two things combining forces today. On the one hand, the prospect of talks between the US and China, and an upside surprise to the payrolls report.
This was a solidly and unquestionably positive payrolls report, coming in above expectations for the headline number, but also participation rate, also hours worked. So it raises this question: if we already have a really solid trajectory underpinning the economy going forward, how much can the U.S. boom should there be some resolution to some of the trade tensions?
That's the conversation we need to have right now for our audience worldwide. Welcome to the program. We can now get the reaction from the White House, the administration, reacting to a stronger than expected payrolls report. Joining us now is Stephen Myron, the chairman of the Council of Economic Advisors. Stephen, welcome back to the program, sir. Thanks for making some time for us this morning. Let's just take a little assessment of where things are right now. So through the week, GDP, first contraction since 2022, consumer confidence the weakest since May 2020, manufacturing shrinking on the ISM report, and then we just had this very solid payrolls report. What's your assessment, Stephen, of where things are at the moment?
Good morning. Thanks for having me. And let me just say that I know that surveillance usually ends at 9, so I look forward to you guys benefiting from the president's forthcoming no tax and overtime. So thanks for staying a few extra minutes. But no, look, I think there's been an ongoing disconnect between the hard data and the soft data, and the hard data continue to perform very well. 177,000 jobs last month, a beat of 40,000 jobs. That's the president's second jobs day beat in a row. And on top of that, you've got 11,000 construction jobs, expanding construction sector in spite of the president's crackdown on the border, disproving critics again. And the hard data continue to be okay. And I think it's worth emphasizing that these data represent the period after the president's historic actions with tariffs on April 2nd.
So, Stephen, we need to get into that, because there are some people that we've spoken to that worry about the next report. They think that this could show up in the May report. And I've heard the words downside risk repeatedly. Are you confident that some of that's avoidable?
So, look, given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also, as companies sort of substitute activity from one month to another. That remains to be seen. But so far in the hard data, we're not seeing any real evidence of that to be the case. And as you pointed out, there are various soft data sentiment indices that look not as good. good, but those tend to be influenced by financial markets, and there's been enormous volatility there lately, as you guys are aware, and they tend to be influenced a lot by politics. But historically, the correlation between those and activity has been weaker in the last few years than it would have been, say, 10 years ago.
We are seeing it show up in some hard data, and that's trade volumes. We just caught up with the Port of LA director, Gene Soroka. Stephen, I wonder if you've been in touch with them and how you see this playing out. They're telling us now that trade volumes are about to fall, that what they're about to see through their port could drop by something like a third, 30%, and then from there this could ripple through the US economy. What's the sequencing of things from your standpoint?
Thanks. So as I mentioned a moment ago, there can be some volatility in the economic data, and I think it's worth emphasizing that there are some firms that want to see the outcome of trade negotiations, which will be coming soon, and they want to see the tax bill passed, which again will be coming soon. And as a result, they may substitute activity from one month to another, from one quarter to another, but it all gets averaged out over time. These are not the types of activities for which activity would get canceled permanently. And as you mentioned at the start, the GDP report contained a 5-point drag from import activity. So we're just coming off of a quarter with an enormous amount of imports that by the way, there was a data anomaly in the GDP data that I'm sure most of your audience is aware of by now. But after such a huge import drag on the economy in the first quarter, it wouldn't be surprising if there were a little bit less imports subsequently. I mean, but this stuff all averages out over time. And that's why it's important to look at measures of underlying GDP growth, underlying economic activity, and those were quite strong.
As you know, the market's very focused on trade talks right now, and that's why we've seen equities recover to the extent they have over the past week. Stephen, the US says China wants to talk. China's going around saying the US wants to talk. I don't think the market really cares about that. The market just wants to see talks. What's the timeline for actual talks?
So the president has repeatedly said in recent weeks, and he's been very clear, that he thinks that we will do a deal with China. I think the president is right. And as I keep pointing out, the president has one of the best track records on making deals in the entire history of the country. He is able to pull deals out of a hat that nobody thinks are possible. He pulled the phase 1 deal with China out of a hat in 2018, 2019, in spite of all the doubters. Many people didn't think that was possible, but he achieved it. And so I think the president is right that we will have a deal with China. I can tell you, I can tell you that I have good reason for that optimism. I think that it's in the interest of both economies to lower the temperature, to create breathing space, to continue talking, to figure out how we can get to a new stable equilibrium on trade. And I think that a little bit of de-escalation will be quite helpful. So I would be surprised if tariff rates are where they are now, within a few weeks from now.
A few weeks. So you're saying within a few weeks, the 145% tariff rate on China is bound to come down, and to where, Stephen?
Well, I can't get ahead of negotiations. I can't make commitments. I'm not part of the trade negotiating team. I'm not a trade negotiator. But what I can tell you is the president has been very clear that he thinks that there will be a deal with China, and I think the president is right. And I think it's in the interest of both sides to come to a de-escalation that lowers the temperature and creates breathing space.
Well, China this morning put out a statement, the Commerce Ministry, so this is official, saying China is currently evaluating this. Do you have a sense when the president is going to get on the phone with Xi Jinping?
I don't. And again, I'm not a trade negotiator. I'm an economic advisor. That's the scope of my role. What I'm giving you is my expectations. I can't get ahead of the negotiations. I can't commit anyone.
Stephen, I wonder if you could give us some insight, though, just to the approach we're taking at the moment. The Treasury Secretary mentioned just yesterday that maybe we could revisit the purchase agreements that we struck with China back in 2020. Is that something we'd look to do with other nations as well?
Look, I think that there's a wide variety of terms that can be included in the different negotiations, and each country is different, each trading partner is different, and I suspect that each trading agreement that is reached will end up being different too. But things like that should definitely be on the table, and I think it's up to other countries to show America that they mean to make trade more fair, they mean to make trade more reciprocal, and they mean to create better markets for U.S. exports the way that we accept their exports into our markets. And purchases like the type you're describing, could work towards that end.
Well, the Europeans are looking at increasing the purchases of U.S. goods to 50 billion euros to address what they say is the problem in the trade relationship. Is that enough to get a deal done between Washington and Brussels?
Again, I'm not a trade negotiator. I'm not making deals with people. I'm just an economic advisor. And, I can't say, I can't prejudge the outcomes of those deals. However, what I will say is that talking is better than not talking. And I do believe in the ability of the president to create deals that nobody expects. And once you start on that process, I think that there will be fertile ground for countries to see eye to eye to make trade fairer, more symmetric, more durable, more resilient, and create a more long-lasting, stable global trading system.
Well, the Japanese are talking, and I think this is something that you can offer some insight on. An assessment on what this could mean for financial markets and the economy, and we'd love to know the kind of advice you'd give in the Oval to the President of the United States. The Japanese finance minister was asked if Japan's holding of treasuries could be a negotiation tool, and the response was this. Here's the quote: "It does exist as a card. Whether or not we use that card is a different decision." Stephen, what's your reaction to that?
My reaction is that I'm not the Treasury Secretary, and you should ask my neighbor a couple blocks down.
Do you have an assessment on what that would mean for markets and the economy, though?
I don't, but for markets and the economy, I think that capital flows will ultimately, in the long run, follow economic growth and economic opportunity, and that's why the president is focused on creating the most dynamic, strongest, healthiest economy in U.S. history. And we're talking a lot about trade, but there's two other elements to the package also, and those are tax relief for Americans, no tax on tips, no tax on overtime, no tax on Social Security, incentives for corporate investment, lower corporate rates on domestic manufacturing, expensing, things like that, and also deregulation, getting regulations out of the way so that American firms can produce in America without layers and layers of red tape that make financing difficult, that delay projects, and just make it unattractive to invest in the United States. And as we succeed in creating the economy we want by passing the tax bill, the big, beautiful tax bill, by proceeding with the deregulatory effort and getting government out of the way and putting American workers on fairer ground via trade renegotiation and tariffs, then we're going to create the economy that will attract capital flows. So all of this stuff in the short run, it's a little bit noise, but in the long run, capital will follow economic opportunity, and this administration is focused single-mindedly on creating economic opportunity for American firms and workers.
So, Steve, let's quickly talk about the big, beautiful bill. What kind of revenue do you expect from the tariffs to offset the tax cuts the president wants to get across the line?
So when you talk about things like offsets, that's ultimately, usually people talk about that as part of the reconciliation process, which is basically as your audience knows, a legal artifact of how the sausage gets made in Washington and how bills, and how bills come together and get signed into law. The tariff revenue is sort of a different bucket. I'm not at liberty to share our internal number, but what I would say is I would be surprised if we had tariff revenue, that was less than hundreds of billions of dollars a year. And that's very substantial. So when you think about the revenue that you can raise from tariffs, ultimately paid for by foreigners, use that revenue to help finance preservation of the president's historic 2017 tax cuts, use that revenue to help finance additional tax relief for American firms and workers. I think that's a winning combination.
Steve, right now the market is basically just only pricing in the fact that there's going to be an extension of current policy. How confident are you that you get some of those sweeteners like you just mentioned, no tax on tips, actually done in this package, given how slim the Republican majority is in the Senate and the House?
Oh, I'm very confident that we will get this package over the line. I'm extremely confident we'll get this package over the line. The entire Republican Party is unified and committed to using tax incentives to create a vibrant, robust, healthy, and dynamic economy. And that was what created the first Trump economic boom, and it's what will help create the second Trump economic boom as well.
Stephen, just a final word on the Federal Reserve, if we may. The president's been outspoken, as you know. He said we should reduce interest rates. The Treasury Secretary, Scott Bessent, made the argument that look at where the front end of the yield curve is right now, the 2-year trading below Fed funds. That's evidence that this market thinks we're too tight and the Fed should cut rates. I just wonder from your perspective how you'd weigh in. Do you think this complicates the optics for the Federal Reserve? Does it make it harder for them to ease over the next several months?
Sure. So, I think everyone's entitled to an opinion on interest rates and where they should be. And the president actually has a pretty good track record of his opinions. He was right in 2018, 2019 that inflation wasn't an issue and that interest rates were too high. And eventually consensus came around to his view. And again, he was right in 2021 that interest rates were too low and inflation was coming back big time. And again, consensus came around to his view. So everyone's entitled to an opinion on these matters. I think the president has a great track record on them, as does Secretary Bessent, who has a fabulous track record as an investor on these subjects, and everyone's entitled to their view. As to whether it interferes with the things you're talking about, I don't think so. I think the track record of the Federal Reserve speaks for itself.
Stephen, can I just say, I really wanted to catch up with you. I did this for free. No overtime, okay? But I'll take the tax break. I will take the tax break. Stephen, thank you, sir.
Well, Stephen Mariner. The tax break is coming.
Thank you, sir. The chairman of the Council of Economic Advisors. With us around the table still, Mohammed Al-Arian and Stephanie Roth. Lisa, first to you. I wanted to come to you and get your reaction. The takeaway there, just on China, that those tariffs won't be around in a few weeks' time. They'll be changing.
They're going to be coming down to a significant place, not necessarily giving any commitment to what they're coming down to, but a sense of progress, which is what you're seeing reflected in the equity markets. What this means going forward for further talks, how complicated this is, and economic projections. I'll let the markets figure that out.
An olive branch very early this morning from the Chinese Commerce Ministry, now an olive branch from the White House saying they are unsustainable, repeating what we've heard from the likes of Scott Bessent. But Stephen, they're talking about the fact that they're coming down in a few weeks. Clearly, this administration has been, I think, spooked a little bit by the retailers. They do not want to see empty shelves this summer, especially leading back to September and back to school season.
Mohammed, there's been a tone shift, without a doubt. Your thoughts, please.
I'm surprised about what I didn't hear. You know, the consensus view is China has a tolerance that's much higher than the US, and that is an advantage in negotiations. If I was from the administration, I would be out there and saying the economy has resilience. We have multiple objectives for our tariff policy, not just fairer trade, but revenue, reshoring of industry. And this tells us that we can wait until we get the right terms. I didn't hear that, and I would have expected them to turn this good jobs report into a negotiating tool.
Stephanie, you certainly saw that strength earlier on this morning.
Yeah, the challenge is we just don't have that much time. If we're sitting here with stores that are empty, the administration is going to be scared of that, and they're hearing signs of that, and I think that's why they're talking about tariffs coming down in the next couple of weeks, because the U.S. economy only has a couple of weeks. China can play the long game here, and they can. And this is exactly the point in the negotiation, that the U.S. economy just doesn't have that much time before this becomes a real problem. And the next jobs report is going to look a lot softer than this one.
Aren't you excited for the weekend? No overtime for this. Let's go. Mohammed Al-Arian at Queen's College, Cambridge. Thank you, sir. Alongside Stephanie Roth of Wolf Research. To the both of you, thank you. To you at home, thank you for choosing Bloomberg TV. Coming up on Monday, Chris Verona of Strategas, Chris Harvey of Wells Fargo, Eric McLaughlin of the Conference Board, and the former St. Louis Fed President Jim Bullard. To all of you at home, have a wonderful weekend as we count you down to the opening bell. 15 minutes away. We're looking at 9 days of gains on the S&P 500, potentially the longest winning streak in 21 years. This was Bloomberg Surveillance.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter. like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Futures rally hard, 12 minutes until the start of the cash trade on this jobs day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. We're wrapping up a packed week with a robust jobs report. You can see that futures shaking off some disappointing tech earnings last night, rallying. Exactly. Taylor Swift style, you can see the S&P 500 up 1.2%. We closed out 8 straight days of gains yesterday. If we make it to number 9, that'll be the longest streak since 2004.
Stocks to watch today include Apple. It plans to source more than 19 billion chips from the U.S. this year as part of a global supply chain shift to gradually lessen its reliance on China. It sees a $900 million hit in this quarter alone coming from tariffs. It'll be the first Mag 7 stock to drop on earnings this quarter.
Interesting. We're seeing Amazon saved by that jobs print. It actually turned in the green after we saw that. Yet it expects a tougher business climate in the coming months due to tariffs and a potential downturn in consumer spending, with the slowdown already appearing in third-party revenue.
We're going to dig into those reports in detail, but Bloomberg just spoke with Chairman of the White House Council of Economic Advisors, Stephen Myron, about the state of this labor market.
Given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also as companies sort of substitute activity from one month to another. That remains to be seen.
All right, for more reaction to the jobs data, we bring in Bloomberg's chief economics and policy correspondent, Michael McKee, joins us here on set. And 177,000, better than the highest estimate in our survey. Is this economy on fire?
The economy was very strong coming into 2025, and the labor market was the strongest part of it, which the Fed has acknowledged. We are seeing a slowdown. We got 177,000 jobs. March was revised down to 185 after 58,000 jobs were subtracted from March and February, but it's still a healthy number. The 3-month average is 155,000 jobs a month. That's up from 133,000 last month. Unemployment basically unchanged, even out to 3 digits. Average hourly earnings, all basically unchanged on a year-over-year basis. We always talk about the biggest movers, but this time I looked at what moved that might have been affected by tariffs. Healthcare and social services, social assistance. A lot of the charities that the Doge people were cutting back on funding to didn't make a difference. Still 58,000. Construction jobs. We were supposed to lose construction workers because of the immigration crackdown. Didn't happen. 11,000 jobs there. We did lose 9,000 in federal government. We would expect that to rise in months to come. And computer manufacturing, I just threw that in there, down 4,000 jobs. Semiconductor manufacturing also down 1,000 jobs.
All right, Mike McKee, stay close. We're going to see you at the top of the 10 a.m. hour as well for factory orders. That is Bloomberg's Mike McKee. And let's keep this conversation going now with BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, it's great to see you again on this jobs day. You take a look at the pre-market action. You have stock futures flying right now. You have traders backing away a little bit from their Fed rate cut bets. It seems like traders are taking good news as good news here. Is that your read as well?
So I think there's a couple things at play. I think the rate market is rightfully factoring in. You got an economy that's still solid, that labor is still solid. It's got to keep the Fed on hold for a longer period of time. So I think that's the right adjustment. Listen, the equity market, I tell you, this is one of those interesting periods of time where there's so much cash that's been sitting on the sideline that even though valuations and equities, quite frankly, are not that attractive, that money keeps flowing in. And it's something with the story improving about maybe we get some trade deals. You're seeing momentum and sentiment push it along, even though when you actually break down valuations in the equity market today, I would say they're not terribly fulfilling.
Rick, let's talk a little bit more about the jobs numbers themselves. I know that you've been looking at this not just on a standalone basis, but on a 3-month rolling basis at the minimum. What are you seeing in terms of the trend, in terms of where jobs are coming in and going away? Is there anything encouraging at this point, or are you more discouraged?
No, so I think, I don't know, I actually brought a chart with me, I have a little visual aid that I don't know if y'all can show that. So,
yep, right now.
Mike McKee, there you go. Well, Mike McKee said, which I think is incredibly important. We have a service economy. People that talk about the death of the U.S. economy don't respect the fact that services push this economy along. Healthcare, you look at healthcare and education, and then obviously leisure and hospitality, they just continue to move along. Less trade, less tariff sensitive. And then people spoke, I was listening to somebody today talking about the goods economy. When you actually look at what labor is, the labor is a service economy, and it's still humming along at a pretty good pace. Here's what I think is the delta of where we are today versus where we were a month or two ago. Services are still doing well. I am focused on healthcare and education and leisure and hospitality because I do think you'll start to see those cuts come through. You know, we talked about some of the federal funding cuts to healthcare. I think the next couple of months that'll start flowing through. Leisure and hospitality, you see some of the tourism data coming off. I think that'll start to flow through a bit. So I think the delta is to slower numbers. And you know, the interesting thing in the JOLTS report this week, look at job openings. That's actually, in some of the sectors I just identified, that's coming off. CEOs, CFOs are sitting in this point today, I'm just going to wait. I'm going to cut my job openings. I'm going to keep my labor in place in case the economy actually does okay and we get through some of these tariffs. But it's really interesting. Openings are coming down. So the delta is lower, but it's coming from a pretty solid place. And services, when people keep, arguing U.S. economy, service economy is pretty darn good.
I wonder how important manufacturing jobs are to you, Rick. I mean, Ralph Schlosstein told us manufacturing makes up only 8% of U.S. jobs. And on the other hand, if you have a good union job building cars, you can support a family with that in Michigan. So is it really key to bring back these manufacturing jobs, or do we want to move forward with higher tech service economy?
So Ralph's a smart guy. I would say I agree with everything that was characterized. I would say a couple of things. One, I do think that you'll see manufacturing. You see the pharmaceutical industry start to motivate towards putting more people in the U.S. I do think there is a social aspect, quite frankly, to bringing people back into some of these areas of manufacturing. And I think you'll see that take place. Listen, first of all, it takes 3 to 4 years really to get that sort of dynamic moving and to see some significant impact there is point one. Point two that I think is significant, robotics and automation will dull the labor impact you'll see from that. I think more factories that come back in manufacturing will be with a lot of robots and automation. And then I think the third point that is significant, listen, the growth of technology and innovation, and you think about chip development, et cetera, they are critically important to the United States from a growth, from a national security point of view. And so I think that's where you'll see the primary aspect of what you would call new manufacturing today.
All right, Rick, you're sticking with us through the opening bell. Hold tight for just a moment. Let's take a look at the setup as we count down to the ringing. You can see the S&P 500 up 1.2% right now. What a run we've seen on the big benchmark. You can see the NASDAQ 100 also higher, even though we had a little bit of disappointment from Amazon, from Apple. Amazon shaking that off again, Taylor Swift style. And then you have the Russell up as well. It's going to be interesting, guys, to see if we can close in the green on this Friday. We know that traders have been reluctant to hold risk into the weekend, but if we get 9 straight days of up arrows, that is the longest streak since 2004.
As you've been saying all week, yesterday was window dressing, but window dressing is over. It's time for people to return to trading.
Yeah, the best string of gains, though, in 21 years, this is Bloomberg.
asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we are looking at some pretty significant gains, especially considering that we're just passing over an 8-day streak. So if we finish in the green today, it'll be the longest winning streak we've had on the New York Stock Exchange in 21 years. That's longer than many of my colleagues here have been alive. NASDAQ futures up 1.1%. Russell futures all up 1.1%. And ringing the opening bell, really knocking it out of there, is Oscar De La Hoya. And Ring Magazine, which is, I guess, a boxing magazine, and they're partnering up with Fatal Fury, which is a video game. I need Joe. Sometimes I need Joe in the control room out here to help me out with the sports stuff. Down at the NASDAQ market site, you have Fold ringing the open bell, FLD, and they brought a huge crowd of people. What a day to be involved in financial markets. I mean, the kind of record we're looking at, Katie Greifeld, is generational.
Generational. I do have some bad news, though, and that comes in the form of Apple. Apple planning to source more than 19 billion chips from the U.S. this year as part of its global supply chain shift to gradually lessen its reliance on China. But even still, Sonali, we learned last night that it sees a $900 million quarterly hit this quarter alone from tariffs, so standing out from the rest of its Magnificent Seven peers in a bad way.
Yeah, this one, too, is interesting. Amazon had been fluctuating into the market open. Now it's down, well, roughly flat. It's been fluctuating between 0.2 and 1% down and flat. It expects a tougher business climate in the coming months due to tariffs and a potential downturn in consumer spending, with the slowdown that's already appearing in third-party revenue, Matt.
Yeah, I want to point out also that Chevron will reduce share buybacks this quarter due to tumbling oil prices. I know since the first quarter we're down about 17% on crude prices and the trade war. Meanwhile, Exxon is sticking with its share buyback plans as earnings met estimates there. So kind of a mixed bag in terms of the oil patch, but both of those shares are rising right now. And we've got some breaking news on a meeting at the White House. President Trump set to meet with Mark Carney, the new leader of Canada.
Right, he had a good week.
And this is interesting because Carney, you know, in his sort of victory speech after the elections this week, he said, like, the, you know, friendship and partnership and collaboration between the U.S. and Canada is over.
Yeah, he did run on that sort of anti-Trump sort of platform. It ultimately got him the victory, but now learning that Carney and Trump are set to meet at the White House on Tuesday, it'll certainly be interesting to watch that one.
Yeah, Tuesday next week is a busy week, of course, and we should be prepared for that because we're going to move past these earnings and back into the political rhetoric. That meeting on Tuesday will be closely watched, in addition to many of Scott Bessent's hearings.
Exactly.
Well, before we move on entirely from earnings, let's talk about two of the big ones, Apple and Amazon's results. Let's take a closer look now with Bloomberg Technology co-host Caroline Hyde sitting to my left. I want to start with Apple because there were already a lot of fears heading into this print, of course, the relationship with China, the reliance on China, and it seems like actually a lot of those worries were founded in reality.
Yeah, Tim Cook just reminded everyone of their exposure and the fact that they're already saying, look, costs are going to add up to $900 million. That's not a lot if you're comparing that to, well, your expectations of about $90 to $100 billion in revenue. It's about 1%. But that is the best case scenario. So says Jefferies. This is why we got not one but two analysts downgrading the stock today. And in fact, Jefferies going all the way to an underperform, saying this is as good as it gets. You're going to have, of course, perhaps tariffs not remaining still as they are in the next June quarter. We're going to potentially see a dial-up of focused tariffs on electronic goods, such as smartphones. So overall, we're going to see a real concern here. Apple really couldn't point past what happens in the June quarter. And also that weakness in China, just persistent. They had subsidies in China. We're meant to see a pickup, but no, sales were still down 2%. They cannot get their AI act together. They're not having a foldable phone yet, and they're losing out to competitors over in China. Meanwhile, in the US, yes, you're building chips closer to home, but that adds up.
Speaking of competitors over in China, I think this week was an incredible one for Amazon. The numbers themselves were not so pretty. They were down more than 3% pre-market. The jobs numbers showed up and it saved them a little bit because they are so exposed to this consumer, the American consumer. But Chinese rivals have been raising prices already. Yes. So is this an advantage story or a disadvantage story?
I think when you're thinking of Amazon, if anyone can weather it, Amazon can weather it. It's kind of where analysts are. And the sales look good. Not only did they beat in the quarter that they just reported, but they're also posting that revenue is actually going to remain resilient. They're going to see about 8% growth once again. They might take away something on profit, but people are used to that when it comes to Amazon. Just go back to the Bezos days when he was running it, and now with Andy Jassy, they're always willing to flex a little bit on their operating margin if they're going to reinvest in the business, and they seem to be committed to satellites in the sky. They're committed to AI innovation and wanting more people to come to Bedrock, more people wanting to come to their own chips. So they're not going to say in this moment of anxiety, we're dialing back on our own R&D, but you're going to have to suck up a margin hit. I think most analysts actually said, look, generally speaking, they beat when it comes to their operating income. They beat hard this quarter. Look, the guide, they're just being cautious here.
All right, Caroline, thanks very much. Bloomberg's Caroline Hyde. She hosts our technology show, which kicks off at 11 a.m. with Ed Ludlow, and you can watch that, well, at 11 a.m. As I said. We are back with BlackRock Chief Investment Officer, Global Fixed Income, Rick Reeder. Rick, you also run BINC, the ETF, which is outperforming the benchmark, really crushing it, and up year to date as opposed to the S&P, the broader index, which is down still almost 4% year to date, still off 8% from its highs. What do you think about stocks after a 9-day winning streak? I mean, do you take some profits here?
So thanks, Matt. I mean, so I also run our global allocation fund where we do mostly equities. Listen, I'd say a couple of things that we're doing in the equity market. First of all, this is as good a trading environment as I've seen in a long time. You know, there was a period of time where people were panicked about the downside, and you could sell puts on the market, reduce your equity beta, sell puts. And now you've got this amazing froth that, you know, you ride it a little bit. You run your equity beta a little bit longer because the sentiment's good. Maybe you get good news on trade. But now there's a great opportunity to sell upside calls because people will pay for the up 10%, 15%. And buy some downside. And so that's what we've been doing recently. You know, ride this a little bit, keep your beta elevated, but you can buy some downside protection. And I think, quite frankly, you know, some of the names that are moving now in tech and otherwise, you can sell some of the upsides because people have gotten super excited again, and then protect yourself so you can ride an equity market. Listen, the valuations, you're talking about 22, 23 times earnings. These are not great valuations. It's a sentiment-driven market. And it's one that there's just so much cash that people are looking for an opportunity to put some money to work. So anyway, you ride that, and then you know try and protect yourself in terms of any bad news.
Rick, it's funny. You have to keep reminding us that you're not just a bond guy. Unfortunately, that label has definitely followed you. But when it comes to what you're describing in the equity market, you know, protecting on the downside with puts, selling upside calls, it's interesting. It kind of sounds like you're trying to generate income through the equity market with some of these options structures.
So yeah, yes on generating income, but also to try and, you know, create the right convexity of your portfolio, meaning can you participate in a market where it's rallying, but then also when people get excited about the upside, can you build some downside in the portfolio? And then the flip side, I mean, we were selling downside, we'd reduced some risk. And so selling some downside in things like the banks. You remember, if you go back 2-3 weeks ago, banks were down 25, the big banks down 25-30%, and the volatility that usually trades at 20-25 was at like 80 to 100. So those opportunities present themselves. So trying to take advantage of, yes, build income when you can, but really trying to take advantage of where, quite frankly, I think we live in markets more than anything I've ever seen, where people overreact, sentiment drives it, momentum drives it, and just trying to be on the other side of that when it gets a bit extreme.
Yeah, I've been watching those bank sell-offs as well. It's pretty incredible how they've been moving around. Now, Rick, one thing that's interesting to me is even after this morning's data, you do see more than 4 rate cuts priced in through the end of the year. And then you have Treasury Secretary Scott Bessent saying that the short end of the yield curve is also suggesting that maybe the Fed funds should be lowered too. Want to know what you think, because does really the economic data that we see right now warrant rate cuts so early in the year? You have one priced in right now to May.
So I've learned in my career, it's not a question of what I would do or how I would, what do I think they will do? And I think today this Fed will wait, and I think this Fed will take its time. Like you say, you look at this payroll data, and you take inflation that's running, depending on the metric you use. So let's say you use core CPI. I know they prefer core PCE, but if you use core CPI and you're running at the 3-month, 6-month moving average of 3%-ish, and then but pre-tariff, so you add another 30 or 40 there. Listen, it's not really an environment for that this Fed would interpret that and say, time to cut. So listen, I think the labor data will, we talked about around openings, slowing. I think the labor data will open up the window as you get into the June meeting, or maybe a little later than that, to get a couple of cuts done. But I think interpreting that they're going to cut off of today's data, I think, is presumptuous.
I want to correct myself here. They're not pricing in May. They are pricing in one in July. And actually, you do already have a little bit of a change in the pricing already for the end of the year.
We're studying the warp function here.
It's changing on me this morning, Rick. Forgive me.
Even as a budding equity guy, I'm sure you still remember WIRP Go on the Bloomberg terminal. BlackRock's Rick Reeder, fantastic spending some time with you. Have a fantastic weekend, Rick, and can't wait to see you back here in New York City. Some more movers on our radar today. Duolingo jumping as AI fuels strong results. Katie's learning a new language with that software. Take-Two is falling after delaying Grand Theft Auto, isn't it 7? Grand Theft Auto 7 until next year.
I believe it's 6, according to our producer.
Yeah, sorry, VI. It is 6. So it won't come out until 2026. Gamers are bummed. Take-Two is down. By the way, Electronic Arts is soaring on that. And Reddit says revenue in the current quarter will be higher than Wall Street estimates, but apparently investors still don't like the stock. It's off 4%.
Well, funnily enough, Bloomberg spoke with Reddit's COO Jen Wong about the company's growth. Let's take a listen.
It was a strong quarter for Reddit. Users were up 31% year over year. Revenue was up 61% year over year. And we're seeing continuing momentum from Q4 into Q1 and Q1 into Q2. I think the work that we're doing is working. When I think about our roadmap, making Reddit more accessible to people globally, improving the product.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence
from brain cells in a dish. This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, it's time now for top calls from the analyst action in focus this morning, and we start with Airbnb getting downgraded at Wedbush on slowing U.S. travel trends. The company also reported a disappointing Q2. Next up, we have Block getting downgraded over at Wells Fargo after reporting earnings well below Wall Street expectations. The fintech company also cut its guidance, citing macroeconomic pressures. You can see shares down a whopping 23% right now. And finally, Apple getting hit with 2 downgrades today. That's after it reported earnings last night that reinforced concerns over tariffs, also its growth potential. Those 2 firms are Jefferies cutting the stock to a sell and Rosenblatt downgrading the stock to neutral. Shanali.
Sell is a tough place to be living in. We're going to stick with Apple because it was a busy week of tech earnings with Apple, Amazon, Meta, and Microsoft all reporting. Let's recap it with Jordan Klein. He's the head of technology specialist at Mizuho Americas. Apple. Right. I mean, when you look at the exposure it has to the broader economy, when you look at the sentiment from Wall Street turning on the company a little bit here, how do you see the path playing out for the remainder of the year, given the uncertainty around tariffs?
Yeah, thanks for having me. I think Apple's clearly going to be in that kind of wait-and-see bucket. I mean, Tim Cook and the management team got a lot of questions on the earnings call about tariff impact, how they would adjust their global manufacturing footprint to minimize costs. I think they did a pretty good job of laying out what they will do to avoid, tariffs and adjust the, where they make the phones coming into the United States to kind of alleviate some of the concern. That being said, the biggest overhang, in my opinion, is what do consumers do in terms of, do they need and want to go out and buy a new expensive phone that's $1,100, $1,200 right now? The economic outlook looks relatively unclear, but right now the data's okay. So I think for the time being, it's going to be in that, I don't feel like there's more upside to earnings estimates. I think most people feel like right now, if you had to guess between now and 6 months, there would be more downside risk. So to me, it's just a matter of people wanting to put their money probably in safer names.
It's crushing to see a 19% drop year to date on Apple. I will point out, though, that there are still only 4 sells out of 60 people looking at this stock. So I don't think anyone's excited to get out, Jordan. What about the importance of Amazon, the importance of Microsoft? You noted to our producers that you think they are by far the most important of the four big seven that have reported this week. Why?
Well, I kind of was saying this week that what was going to matter the most for tech sentiment and investor sentiment would be the big cloud hyperscalers. Not stocks like Apple that have a lot of consumer overhang, but Microsoft, Amazon, Meta, and they come after Google because these are the companies that are spending hundreds of billions, have these massive cloud footprints. They touch all areas of the economy and basically the enterprise. So what they were seeing in terms of AI and just regular cloud demand and how they were going to approach the need for more data center capacity to handle that demand was going to be critical in terms of where these stocks in the tech sector would head next. And by and large, I think people came out of this week, despite Amazon being a little bit weak today, I think by and large, Meta and Microsoft were a big positive shot in the arm.
Yeah, absolutely. And you've seen that trickle through in the indexes. I want to talk about Amazon a little bit more. Amazon's a really interesting stock to cover, I imagine, because it's the world's largest online retailer, but it feels like the actual shares move more on its cloud business, what it's doing in being a hyperscaler. And I wonder, you know, how you weigh those two different sides of this business as you cover this company.
Yeah, I mean, for the record, I'm not a publishing analyst, so I don't officially cover it, but I do follow it closely, and you have to if you are a desk analyst or a sector specialist like myself. So that is the challenge with Amazon, is they have two distinct businesses that are very different, but also very big, and one's growing really fast. That is the cloud business, and it generates pretty much the majority of their operating income. And the other business is retail, which is massive. And I think, you know, the opportunity there is huge as they expand into new categories and new offerings. So right now, I think a lot of investors still want to see upside and strength in AWS. That's kind of what carries the higher margin or value. Whereas the retail e-commerce business, people know they're going to fight for volume and share at the expense of profit. And I think that's just kind of a given, but it kind of makes it different from all these others. So that's why I feel like right now Meta and Microsoft are just cleaner stories with tariff and macro headwinds. Doesn't mean Amazon's not a great company. It just means that it's got more risk associated, namely from that retail side.
Jordan, you really saw a tale of two cities this earnings season with the big tech giants. Are these kind of more business-focused sectors immune to some degree to recession? Because you did see cloud spending, for example, as you said, hold up. Meta reaffirming those CapEx plans. Does that hold, though? I mean, people are flocking to these to a relative strength relative to the consumer-focused names.
Yeah, I mean, that's always the debate that investors will have, is how I wouldn't say none of them are immune. You know, when you see market weakness or any sort of risk of a recession, spending and growth will fall, obviously. But I think what's different this time is that companies are seeing cost savings and efficiency gains from moving their IT spend into the cloud. And they're definitely seeing benefits and are excited about doing more AI-enabled projects to drive, you know, either better customer support, customer relations, also take market share from their competitors. So that's what I think has held up the best, is the cloud and the AI spending. But general enterprise, you are seeing some companies take longer to close on deals or size them down. And I think the debate is going to be, where are you most insulated within these IT tech companies? Like, do you want to favor large mega global companies that have, you know, a very diversified footprint, or will the more nimble, smaller companies that focus on small to medium businesses be safer because the deal sizes are smaller? But right now, I think people are favoring probably the larger size companies.
Jordan, great to get some time with you. Hope we can catch up again soon. Jordan Klein there of Mitsuho talking about the big tech earnings that we've had. Obviously, the M's were yesterday, the A's today.
They didn't do as well as the A's, but still, that's not stopping this market right now with the S&P 500 higher by about 0.9%, now 0.8%. Some of those early gains just lessening a little bit, but still, the S&P 500 now for the year only down 3.4%. Much more coverage of this market coming up next. This is Open Interest.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. They are up, not as big as they were at the open, but the S&P is still gaining 0.9% on its 9th consecutive day of gains. If we keep this up, it'll be the longest winning streak in 21 years. The NASDAQ up 1%. We've had a lot of earnings that I guess really disappointed. Apple we've been talking about all morning, and Amazon as well. These two big stocks are down, so it's pretty surprising with those heavy moves that the indexes are still up. This story I know well, Grand Theft Auto coming out with number 6. I guess people were hoping this year. Now it's not until next year, so Take-Two is down. Electronic Arts, as a result, gets a boost. And then Airbnb and Block apparently disappointing with earnings as well, especially Block, down 22%. So a big drop there. A look at what's ahead today and next week, really. At the top of the next hour, we get factory and durable goods orders for March, so Mike McKee will be watching those closely. Tomorrow, Berkshire Hathaway holds its annual meeting in Omaha, and the Buffett indicator shows that stocks are still cheap, by the way. Jess Menton writing on the BN side. On Monday, we kick off our special coverage of the annual Milken Institute Global Conference, so you better believe Shinali's on a plane there this weekend. Treasury Secretary Scott Bessent will be on Capitol Hill Tuesday, as we told you about, and Wednesday as well. We'll show you both of those testimonies. On Wednesday, the Fed decision and Powell's news conference, and that means we also see Tom Keene back here on TV. The Fed decides. Coming up next, PIMCO's Tiffany Wilding joins us here on Open Interest, then David Kelly from JP Morgan.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Michael Wallace. President Trump is taking aim at Harvard University again. He announced on social media he's taking away the school's tax-exempt status. CBS's Stacey Lynn.
The move comes just weeks after the president froze more than $2 billion in federal funding for the school. Since taking office for a second term, he's targeted major U.S. universities, saying higher education has been gripped by anti-Semitic, anti-American, Marxist, and radical left ideologies.
Does Trump have that power? Here's CBS News legal contributor Jessica Levinson.
There are specific legal grounds that give the IRS the power to revoke tax-exempt status. But it's important to remember that ideological bias or controversial speech in and of itself should not be a reason to lose tax-exempt status.
In a statement, Harvard says there is no legal basis to rescind its tax-exempt status. On Wall Street, stocks have opened higher on a better-than-expected jobs report for April. 177,000 jobs were added. Stephen Janot is a senior economist at Bank of America.
It's a very solid report. You know, there were concerns after ADP earlier in the week came in a little bit soft that we would see a disappointment, but we actually got an above-consensus number in terms of jobs added.
The unemployment rate held steady at 4.2%. President Trump has signed an executive order cutting funding for PBS and NPR. Frank Sesno, a professor at the George Washington University School of Media and Public Affairs, says public media play a vital role.
A tremendous amount of what is done through public broadcasting, especially in smaller and more rural communities, is vital local programming. It may be the only reporter comes from one of those stations who attends the school board meeting or the city council meeting or the town council meeting and then reports back to the community.
Trump accuses NPR and PBS of bias reporting. Actor and comedian Ruth Buzzy has died. She was perhaps best known as a regular cast member on the TV show Laughing.
I had Thanksgiving dinner at a famous surgeon's house, and it was disgusting. After he carved the turkey, he removed his liver and onions.
Buzzy told CBS in 2003 about playing the bitter, purse-wielding spinster Gladys Ormsby.
It was just fun. It was a fun, easy character to do.
She also appeared on The Monkees, That Girl, and Love, American Style. Ruth Buzzy was 88. It could be a messy Kentucky Derby tomorrow. Reporter Ed Peak is in Louisville.
If it rains Saturday, and there is a 70% chance, the track surface could be listed as muddy or sloppy. 4 of the 20 horses have raced on off tracks, with Cole Battle winning 3 times.
This is CBS News. Some pressure cookers are being recalled. CBS's Jim Krasula has details.
They have become hugely popular.
Meet the Ninja Foodie, the pressure cooker that crisps. It's the best of pressure cooking and air frying all in one.
Now, Shark Ninja is recalling around 2 million Foodie OP 300 series pressure cookers sold in the U.S. and Canada. It comes after more than 100 people suffered burn injuries after hot food spewed out of the devices. There have been more than 50 reports of people getting 2nd or 3rd degree burns.
Customers can contact Super Ninja to get replacement lids. A Nigerian teenager has set a Guinness World Record for the world's largest art canvas. 15-year-old Kanye Yachukwu Tagbo Okeke's painting is bigger than a soccer field. The autistic teen made it to raise awareness for autism and raise funds for those on the spectrum and their families. People with the spectrum disorder in Nigeria face stigma. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Jobs Day came in much better than expected, I would say, on the whole, although the revision was markedly negative, so I have to keep an eye on that. Tom Gibble, Vice Chairman, American Staffing Association, or founder of LaSalle Network. He'll give us his thoughts on the job market. We got a lot going on there as well. So, of course, we're going to keep an eye on the tech stocks here. We had some tech earnings this week. We'll break that down with some smart voices there. And then we'll look ahead to next week, more economic data, more earnings. So a lot happening right here. And WTI crude oil below $58 a barrel. I know that interest, Alex Steele.
I do. It does. Yeah, particularly with Exxon and Chevron reporting. Although, to be totally fair, like they do longer-term projects. They're not as going to be influenced as the day whipping is action, but nonetheless.
All right, we're talking oil today.
Oh, yeah.
Oil companies, no question about it. Let's kick it all off with John Tucker and get a Bloomberg Business Flash done.
All right, right now, S&P 500 on track for a 9-day winning streak. The S&P 500 up just over 1%, 59 points higher at 5663. The Dow Jones Industrial Average up 366 points. That's up 0.9%. The Nasdaq 100 up 254 points. That's a rise of 1.3%. We did get that change in non-farm payrolls, adding 177,000 jobs. Just getting some more economic data. Factory orders, when you strip out transportation, that was actually down 0.2%, a negative 0.2%. Apple receiving at least 2 downgrades this morning. This follows the quarterly results that reinforce concerns over tariffs and some of the growth potential. Jefferies cutting the stock to underperform. Separately, Rosenblatt Securities downgrading the stock to neutral from buy. Shares of Apple down 4.5%. Take-Two Interactive Software, the video game Grand Theft Auto, what's VI? I forget my numerals, my Roman numerals. Six. Thank you. Which was expected to launch in the fall, now planned for release in May of 2026. So Take-Two Interactive shares down close to 7%. The Department of Education restarting collections on defaulted student loans after more than 5 years. So this formally ends the era of leniency as consumers now try to navigate the economic uncertainty. There's going to be wage garnishment for borrowers who are not making payments. This is going to begin later this summer. The government estimates about 25% of its $1.6 trillion student loan portfolio could be in default as the overdue payments start to pile up. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Hi.
Hi.
Alex, good to see you.
Good to see you back, JT. Alex Steele, John Tucker, Paul Sweeney, the band is finally back together on Bloomberg Intelligence Radio. Let's take a look at some of the stocks on the move today. For that, we're joined by Bloomberg's Carmen Reinecke. Let's start with Take-Two. So, I mean, first of all, do we really need a Grand Theft Auto 6? Can I say that out loud? Oh, no. Hate mail's coming in.
I don't know a lot about video games. It's like part of childhood that I just completely missed out on. But I know Grand Theft Auto, and I know it's super popular, and everyone's very excited about it.
This is the one that teaches you how to hijack a car.
Sure. I think that's been happening the whole time.
Police.
Cool. But so Take-Two, ticker TTWO, shares are down 7%. This looks like the worst intraday drop since early April. Basically, yeah, they delayed the release of this game. It was supposed to be in the fall, and now it looks like it will be in May 2026. So Wall Street analysts were actually pretty positive on this. Some said that now that there's actually a date, they feel a lot better about it. Until there was a actual solid date on the calendar, they felt that further delays were always possible. So even though stock is down there, most of the analysts were still pretty positive on Take-Two, and yeah, I think the public's really, really waiting for GTA 6.
I remember back in my day, I think it was Grand Theft Auto something, and I did the whole overnight thing with the line outside at some GameStop in the middle of Midtown with a camera talking to people, man on the street, bringing back those memories.
You were a gamer?
No, I was doing it for work.
Oh, for work. Okay.
Yeah. Okay. No, God, no. I was at the camera talking to people doing man on the street stuff for that.
Paul's a veteran of Pong.
Pong.
Yeah,
yes,
there we go.
That's right.
Let's also hit Apple here. So we're looking at a couple downgrades.
Yeah, so there are two downgrades this morning for Apple. The first was from Jefferies, which cut its rating to underperform, which is a rare bearish view on the stock. I think it has at least two underperform or sort of sell ratings. The rest of the street is, rather bullish on shares of Apple. Rosenblatt Securities also cut its rating from buy to neutral. Basically, this comes after earnings that just weren't enough to sort of assuage some of investors' fears around the escalating tariff situation and a slowdown in growth in China. Apple said that it expects the tariffs to boost costs by $900 million in the current period, and analysts really pushed Tim Cook on the call for any indication beyond the current period, which he really would not give. So there's a big question mark there as to how much it could hurt Apple if the tariffs sort of escalate and continue, and how long that goes on. So two downgrades is pretty big deal for Apple. Shares are down more than 4% today.
And let's go to Five Below. So if we take a look at Bloomberg Intelligence's tariff matrix, Five Below was one of the companies that got hit the hardest in terms of having to pass on cost increases. What did we learn today, though?
Yeah, so they gave preliminary earnings. Shares are up more than 6.5%, the best in about a week. They raised their forecast for first quarter sales and profit, which really goes against sort of this idea that they're going to get hit super hard by tariffs. So obviously the quarter reflects sort of before when the tariffs are really getting going. Basically, it seems like a strong Easter holiday, which fell in April this year, is going to help out Five Below, as well as actually consumers pulling forward some of their spending because they're anticipating price increases because of tariffs. So I think that's really interesting that they're expecting people to kind of stock up ahead of the time.
All right. Yeah. Great stuff. Carmen Reinecke, thank you so much. We appreciate that. Carmen Reinecke, equities reporter for Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio. I want to get right to the economic data of the day. It is Jobs Day, and the change in non-farm payroll came in at 177,000. Consensus was 138, so a beat there. The prior period was revised down sharply from 228,000 to 185. So some cross currents there. Let's break it down with Tom Gimbel, Vice Chairman, American Staffing Association, and founder of LaSalle Networks. Hey, Tom, what do you take away from today's non-farm payroll data?
Well, I think it shows that the U.S. economy is resilient. I think that the tariff hubbubaloo, for lack of a better word, hasn't hit yet. Companies didn't know what to do following the announcement the first week in April, so we have some time to show up on that. And I think the real message is small and medium-sized businesses always drive the jobs numbers more than anything else. And so if big companies do layoffs, small companies can now afford to hire some talent they couldn't before, and that's where you see a lot of the hiring.
So since you run one of the leading staffing and recruiting firms in the country, who's staffing and recruiting?
Well, I think that the companies that are hiring are small and medium-sized companies. You're not, when you see the announcements that a company like Starbucks is doing layoffs or what have you, is that you see that big companies have to cut overhead. But when you have small companies, the two sectors that I see a lot continue to be our healthcare, and you're going to have tech service firms. And service firms are going to continue to be doing consulting work. There's technology bases, things along those lines that aren't as directly affected by lack of inventory and trade tariffs of importing products from other countries.
Tom, some economists are concerned that tariffs and just economic uncertainty resulting from tariff discussions could hit small and mid-sized businesses harder because maybe they don't have the same profit margins and resources as some of the bigger companies. What are your respondents in your surveys telling you?
Oh, I think there's no doubt about that I'm talking to leaders, CEOs of businesses every week. And there's obviously a concern due to the uncertainty of what's going on geopolitically and the tariffs. However, at the same time, is that labor, for the most part, can be scaled up and scaled down. And companies right now have to focus on where the opportunities lie. And so what we see right now is there is a fear, there is an uncertainty. However, there's also companies, small and medium-sized companies. Again, I want to repeat, if you're a small manufacturing company, you've got real challenges. If you're a small distribution company, you've got real challenges. But if you're a consulting firm, if you're a services business, if you're a technology app development company, there's still opportunity because companies have to figure out workarounds to the situation, and those are usually going to be technologically based solutions.
To the other side of it, those small, medium-sized businesses that are geared towards the consumer, selling stuff and products and manufacturing, et cetera, are they laying off people or are they just not hiring?
No, I think you're seeing both. Listen, companies are laying off. In good economies, companies lay people off. What you have is in a situation like this, companies have to look at their infrastructure. It's the same thing with unloading real estate during the COVID situation. They might not have needed it all along, but it gives them an excuse to do that. And so, for lack of a better phrase, are companies pruning some talent right now? They absolutely are. And at the same time, you see that if you go and look and search any job board, you're going to see that companies are also hiring weeks after they do layoffs because they're different skill sets, different positions. And so, the word hiring freeze is usually for new positions, but ones that are deemed to be necessary to the business, companies are always going to be hiring in those spots.
Labor hoarding, that's a term I learned during the pandemic. I'd never heard that before. Is that still a thing, Tom?
No, I don't think so. During the pandemic, when people were afraid that there was going to be a boom coming out, and there ended up being one at the end of 20 and all of 21 and some of 22, that made sense. But right now, companies are more sitting here saying, what puts us in the strongest position to compete no matter what the economic climate? And if you're a big company, you do have excess labor, and so it's easy to cut that back. If you're a small company, you couldn't always compete against big companies because you can't pay the same wage. Well, when those big companies prune and lay people off, now you can get some of that talent for a little bit lower price. And at the same time, those people are a little bit feel burned by the big companies. So you get a more engaged employee who really appreciates the quality of life at a smaller, medium-sized company.
All right. We appreciate it, Tom. Yep. Always good to get your perspective. Thank you so very much, Tom Gimbel, Chairman, American Staffing Association, and founder of LaSalle Network, really helping to understand the difference of the big, large companies and the smaller, medium-sized businesses. I never thought that, like, if you get fired in a large firm, that the small and medium-sized firm benefits. That actually makes sense.
Good. Yeah, I guess in certain industries, certain areas. So we'll have to see.
All right, coming up, trade talks are maybe thawing, maybe de-escalating. We're going to get the latest from D.C. and Curran, a Bloomberg Global Economy reporter, will be joining us. And plus the latest from Apple. Anurag Rana, Bloomberg Intelligence Technology Analyst, will be joining us to break through those Apple earnings and the potential hit for tariffs on that. Amazon and Apple kind of dinging those Mag 7 earnings that have held up really well. This is Bloomberg. Happy Friday, everybody.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, it looks like we're at session highs. The S&P 500 is up 62 points. That's a rise of 1.1%, 56.67 on the index. All 11 major industry groups in the S&P 500 higher right now. Communication services That's in the lead, and that is home to Meta and Google parent Alphabet. Dow Jones Industrial Average up 1%. That's a 413-point pop there. The NASDAQ 100 up 249 points, and that is up 1.25%. After the close yesterday, Amazon and Apple reported Apple estimated an extra $900 million thanks to tariffs in the next quarter. They also said the sales in China had disappointed. A trade war also denting consumer sentiment and prompting diners to cut back. Wendy's lowering its sales outlook for this year. The latest restaurant chain to take a hit from consumer.
It's like a McDonald's thing, too.
About McDonald's warned earlier this week that apprehension lower-income consumers have been feeling extended to the middle-income consumers as well. Nothing will keep me away from a Wendy's shake.
Yes.
Well, it's not really a shake. It's just like a big lump of ice cream in a cup.
I like the burgers here. They're solid.
Andy, the Frosty.
Fribble? Are they called a Fribble?
No,
Samantha just said Fribble.
The Frosty is
Frosty.
at Wendy's.
Fribble's friend. I don't know.
I don't know what
Keep
that
going.
is.
Keep going.
And OPEC bringing forward its video conference to discuss June production levels. It's going to be Saturday instead of next week, so you're working tomorrow.
Oh, it's Saturday.
Yes.
It's not Monday.
They just rescheduled this. Originally
Thank you.
scheduled for May 5th. Could determine the trajectory of oil prices. A majority of traders surveyed by Bloomberg anticipating another supply surge from OPEC Plus. And then 3/4 of economists surveyed by Bloomberg now predicting recession or a zero-growth scenario that narrowly avoids recession in the next 12 months. As far as yields, the 2-year, that's up close to 8 basis points, 377 there. The 10-year, the benchmark, that's up 7 basis points. That is at $428. DXY down 0.7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered on all the angles of business, financial, economics, and politics through our lens of our Bloomberg Intelligence folks. Okay, so some of the news overnight was twofold. One, Japan saying that potentially their stockpile of U.S. Treasuries could help act as a bargaining tool within trade talks. Also, China hinting at a possible thaw with the U.S. and evaluating their own trade talks. Joining us now for more is global economy reporter Enda Curran. He joins us now from Washington, D.C. Let's start with China for a moment. What does a China hint at a possible thaw actually mean in real speak here?
Well, I mean, look, what China's saying is they're willing to come to the table and talk. They say as long as the U.S. is being sincere, is their wording. This was commentary from the Commerce Ministry in Beijing overnight. Basically, what, I wouldn't overread this as being like a thaw or an olive branch, so to speak. It's kind of a response to clearly what they describe as outreach from the U.S. side. And we know we've had a lot of commentary from U.S. officials that there's at least some level of talks underway or some level of communication going on with China. So this is kind of a formal response to that. But they also make clear, Commerce Ministry does in its remarks, that if the door's open, they say they're willing to talk. The door's open to talk, but they say they're also willing to fight to the end, and that's their language, making the point that they can gird in and dig deep on this trade war if they want to. So yes, it's a headline that both sides might be coming together to talk, but really it's going to be the beginning of what's expected to be a long process, Alex.
And is there any sense of who needs to move first here in terms of getting these talks going? Because we know how President Trump likes to hop on a phone call or have a meeting with these world leaders and negotiate. He likes to negotiate. Is there any sense who's going to move first?
Well, this is where you get into the argument about who has leverage and who can win this trade war. There are those who say the U.S. has leverage because it's the biggest customer of China, and obviously China cannot respond with like-for-like tariffs, given it doesn't buy as much stuff as the U.S. But what we do know is both economies are showing some signs of hurting. We had good labor data from the U.S. this morning, but we've had other indicators on consumer sentiment and on industrial sentiment and production hinting at some pain there. We know retailers are warning about what's coming down the pipes. We know consumers are worried about inflation here. So clearly there's potential for disruption and pain to the U.S. side. China is stressing it can dig deep on this and is willing to absorb whatever pain is coming down the pipe. So in terms of who has to move first, you'd probably have to say that it might be more in the U.S. interest to get some talks going on this, given the concerns over supply chains. But the administration is the administration's clear-eyed in what they want to do as well.
What did you make of the finance minister in Japan? If we just switch chats for a second, talking about Treasury holdings could be a negotiation card in its trade negotiations. Half of Japan's $943 billion in FX reserve is probably in Treasuries, many say. What did you make of this?
Again, on a headline basis, an extraordinary comment from the finance minister, an extraordinary comment from the finance minister of such a major economy and massive holder of US Treasuries and an ally of the US. So that's your headline. But in terms of the practicality of what the Japanese finance minister is saying, I mean, on paper, yes, anyone who is a big holder of US Treasuries can turn around and say, well, you know, if we don't like doing business with you, we're going to sell your debt and we're not going to fund you anymore. But that works both ways. It's kind of mutually assured pain, because if they go into a fire sale of Treasuries, then they risk losing money on their own assets, their own holdings. And that's probably not in Japan's interest either. So I think this one's more about the warning and tells you more about maybe where relations are at, than perhaps a practical tool that Japan can use. Because people make the same point about China. Of course, it's there, it's a threat, and it could happen, but it wouldn't be without pain for those who are selling as well.
All right, Enda, thank you so much. We appreciate it. And Curran, he's a global economy reporter for Bloomberg News, based down there in Washington, D.C. Appreciate getting a few minutes of his time. Looking at the shares of Apple, they are trading off here today. They gave some numbers last night that really tried to, I guess, quantify at least the initial impact that they say they're going to feel in their business from tariffs as they currently sit. The stock's down about 3% here today. We're going to break it down a little bit further with Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence. So, Anurag, what was the tone on the call last night from Tim Cook as he was trying to explain kind of how Apple's navigating a world where there may be higher tariffs here?
So, they really gave a good number that they're going to get impacted by about 900 million in the current quarter, which I think was a surprise to a lot of people. I think everybody on the call thought the number would be much higher. You know, we had calculated to be almost double than that in the current quarter, but they basically said the stuff that they are bringing into the U.S. to sell, they are being made in Vietnam, they are being made in India, not all of them, but a majority of them, and that helps them to reduce the cost. Now, that's okay in this quarter, which is a seasonally weak quarter, but you know they cannot do that in the December quarter, which is the biggest quarter of the year for them. So let's hope that the two countries can figure out the tariff problems by then, because otherwise it's going to be a much bigger impact on the gross margin line than the 900 million that they talked about.
So I'm looking at the headline that Apple estimates $900 million in cost increases on tariffs right in the third quarter. Right. So if we don't get any kind of shift and the lay of the land is lay of the land now, do they eat that in margin or do they pass it on?
I think right now with when you generate 100 billion in free cash flow, I think 900 million is okay to eat and not worry about the consumer. But I don't think that can go on forever. I think they may be able to raise prices when the iPhone 17 comes out. And that's really what drives the calendar fourth quarter and the fiscal first quarter for Apple, during Christmas holidays.
Anurag, arguably Tim Cook is the U.S. executive that maybe spends the most amount of time in China, probably has extraordinary levels of contact there. On the call last night, what was his tone? Was he suggesting that, we can work something out here, or it's going to get much worse? What was his tone?
So, that was another surprise, I think, for a lot of people, because China revenue fell 11% in the previous quarter. In this quarter, it was down about 2.5%. But on the call, they said if you take out FX, they were kind of flat. So that's not a bad in terms of the reduction in growth rate. They also said in urban China, the iPhone was one of the two top most selling items. So I think things are not as bad as, it would feel like for them in China. But you're right. I mean, any additional, heating up of rhetoric between the two countries could lead to consumers not buying a U.S.-based product or a U.S. brand, and that will hurt Apple. So far, we don't see that really happening at a big scale.
What were some of the questions that you then had after the call? Like, it sounds like you feel like Apple can manage these kind of situations. What were some of the outstanding questions for you?
I think the biggest outstanding question is something that was not discussed that much on the call, was this App Store fee issue just came out a couple of days ago. What could happen? That's a very high margin business for them. We have calculated that, for example, on the App Store in the US side, that revenue could be, north of $10 billion or so. That's a very big revenue stream. And this is a high margin revenue stream. We estimate that the gross margin of this revenue is about 80% or so.
Oh my gosh.
So you don't want to lose that particular or a portion of that revenue just because of, if somebody reroutes the transaction or the app outside the App Store ecosystem.
But isn't that kind of the road we're going down? Isn't that something you think Apple would probably have to give up in some type of concessions to the government?
No, I think they will have to, but the question is going to be, can they offset it with other things? So, for example, let's say you're paying $299 per month on cloud subscription or iCloud. Can they raise that to $399 or $499? Gotcha. That won't hurt either of you, but it does help to offset some of those costs. Mm-hmm. And then there is another legal issue that's overhanging is the Google payment to them, for default in search. We think that's another big issue. So, I mean, in totality, Apple is a story with so many unknowns, so many uncertainties, in the tech space compared to any other vendor that we follow.
You also are steeped in the cloud and what's going on there. So I just want to get your take before we let you go on Amazon, AWS, and then Azure when it comes to Microsoft. I mean, clearly AWS still has the lead, but in terms of a growth rate, it is not what Microsoft saw. What's your takeaway?
Well, and the reason for that is honestly OpenAI's ChatGPT. I mean, no cloud provider has the luxury or the benefit of seeing, their revenue jump up because there are more subscribers more users of ChatGPT or the usage is going up, and that's really where Azure is benefiting Microsoft. I don't think those numbers were that bad last night. I think they were fine given the current environment. The margins were spectacular. But I think what they mentioned, and we'll see how much of that can come online, that they think the capacity is constrained right now. And if that changes, then the second half, you could see some acceleration. And that's good news for AWS.
How about just real quickly, 10 seconds here. I mean, AI spending. Is there any change to the outlook there?
Not right now, Paul, okay. But the big question is what happens in 26, 27. That really is what's dictating, and I think that's the overhang at this point in some of those stocks.
All right, Anurag, appreciate it so much. Anurag Rana, technology analyst, Bloomberg Intelligence, joining us via Zoom here. Again, Apple numbers last night definitely called out some China risk there, and stocks trading off 3 or 4%. Amazon as well calling out some tariff or just economic uncertainty risk particularly to the retail side of their business, e-commerce side of the business. Coming up, we're going to get some more detail on that. We're going to check in with Poonam Goyal. She follows Amazon and all the retailers here. We'll get a sense of what her concern level is about retail sales going forward. S&P 500 up 70 points. That's 1.25%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 on track for its 9th day of gains. And right now, it's a race to losses that were suffered after President Trump's tariff announcement last month. Still, it is down, 7.6% from its record high. Stocks are climbing after the jobs report. We got that this morning. America's economy adding jobs for the month of April, 177,000 non-farm payrolls. Manufacturing payrolls did show a small loss, though. Apple receiving at least 2 downgrades this morning following those quarterly results that reinforce concerns over tariffs and its growth potential. Jefferies cutting the stock to underperform, becoming one of the rare bears on the iPhone maker. Separately, Rosenblatt Securities downgraded the stock to neutral from buy. And right now, shares of Apple, among the most actively traded, they are down 3.5%. Take-Two Interactive Software, worst performing stock in the S&P 500. They say Grand Theft Auto 6, which was expected to launch in the fall, now planned for release in May of 2026. Take-Two Interactive shares down 8.4%. And then you have a Square parent Block. Those shares plunging, reporting first quarter earnings, revenue, and key financial metrics that missed Wall Street targets. Block shares down 21.3%. And we check the markets for you all day long right here on Bloomberg Radio. S&P 500 up 65 points, up 1.1%. The Dow up 1%, up 416 points. NASDAQ 100, 255 points higher. That's up 1.3%. And that is your market update, Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast. And now, looking at the shares of Amazon, pretty much unchanged on the day off, just a little bit. The numbers came in last night, and they're saying, hey, they're bracing for a tougher business climate due to tariffs and economic turmoil that could affect consumer spending. That's according to Bloomberg News reporting there. Let's check in with Poonam Goyal. She covers all of the retailers, including Amazon.com, for Bloomberg Intelligence. He's a senior analyst there. Poonam, how would you characterize how Amazon is characterizing kind of retail sales, the consumer? What's kind of the outlook for them?
I think there's a lot of uncertainty, and we saw that with the outlook. The wide range that they casted on operating profit is a reflection that we're not sure. We're not sure how much prices are going to have to rise. We're not sure what the tariffs will settle in at the end of the day, right? Come early July. But we do know that there's a negative headwind in place and that the consumer could pull back when prices rise. So I think there's a lot of uncertainty built into this forecast. And quite honestly, no one really knows until we know where things will settle.
To what extent do you think Amazon would like to pass along cost increases versus maybe take it in their operating profit margin? How do you think they're going to proceed?
So I think it depends on how high the tariffs are. When you're looking at the tariffs from China, it's very hard to absorb 145% tariff. And I think there will be some sharing going on when it comes to that, because they can't pass along the entire 145% without seeing demand pull back in a meaningful way, and they can't absorb it all either. So I think they will share it. But when it comes to the other countries, the 10% tariff, I think you can absorb some of that if you're Amazon and not let the consumer see the price increase. How does it
typically work for like Amazon's business model? Because I know they have different types of sellers on the platform. How do they differ?
Sure. So there's first-party sellers and there's third-party sellers. When you talk about first-party, that's the inventory that Amazon buys and owns itself. So that's where it has flexibility to absorb prices and to pass along whatever level of prices they'd like to. When it comes to third-party, Amazon doesn't really care what's sold on its platform by who, right? So there could be a shift where, let's say there were, 100 Chinese sellers before, and now you see more sellers coming in from India or other parts of the country to sell product. They take the take rate. So if you sell something on Amazon.com, you give Amazon a percentage of your sales. And the cost increase is really on the seller. But where Amazon weighs in is they want to make sure that they're priced competitively. Amazon wants to be known as the marketplace where you can find low prices. So they will put in some guidelines on how far even these third-party sellers could raise prices on its platform.
I guess the question then becomes, if Amazon's retail arm suffers at all, how does that affect its other parts of its business? Like, how important is that to the driver of everything else?
So retail is very important, especially to the advertising business. But when we talk about suffering from this, at the end of the day, people are going to shop. And they may shop a little less than they did before because of price increases, but Amazon's probably still going to be the preferred outlet of where they choose to spend their money. Because if anyone can pass along a lower price increase, it would be the Amazon of the world, where they have leverage, they have scale, and they have the ability to absorb some of these higher costs. So we do think that you may see some slowdown, but we don't think that the other businesses will be directly impacted by the slowdown in retail.
So, Poonam, you cover a whole wide range of retailers. Is there consensus forming when they will have to make a decision about whether to raise prices, take the margin hit? Is there kind of a time when this stuff's really going to come into their P&L?
Yeah, I mean, my best guess of this is early summer. So a lot of retailers, including Amazon, have pulled forward inventory in anticipation of higher tariffs. So they have some inventory on hand that they can continue to sell at the prices pre-tariff. As that inventory is depleted and it's sold and new inventory makes its way in, prices will have to rise in some capacity. And we think maybe June, July is right about the time that you'll start to see some price increases come through.
Do you think that Amazon should lay out how much will be hit by tariffs? Like, would they even know that? I mean, they break out sales tax, they break out shipping. Why not tariff costs? Like, how easy is it for them to understand that?
I mean, it's easy for them to break it out. Will they do it or not? They've said that they won't be doing that just earlier this week, so we don't expect them to do that, especially not on its main marketplace. Could it do that on Haul, which is their low-priced engine that they've launched earlier this year? Possibility still, but I don't expect them to do so on the Amazon marketplace.
Talk about their advertising business. That's become a really meaningful revenue stream with some good growth rates and some pretty decent margins there. What are they saying about advertising, and to what extent that is a cyclical business, advertising? So what are they saying about that?
It is a cyclical business, but they're very, very young in it, right? So there's plenty of growth available to them, given just where they are in the advertising world. It's about over $60 billion annually, and we expect it to get to $100 billion.
Wow.
At high teens growth, given just how young it is, we do think that their advertising business will stay strong, especially given the number of eyeballs that you have on Amazon, right? If you're trying to drive business, if you're trying to sell product, the customer is on Amazon.com, and that is where you will be seen.
All right, Poonam, thanks a lot. Really appreciate it. Poonam Goyal, Bloomberg Intelligence Senior Retail Analyst. She covers e-commerce and retail for us as well. I think the question, though, too, is it's not only important for, say, advertising, et cetera, but it also feeds the beast.
Yep.
For its cloud computing business. Like, that's the cash cow that does everything else. And if you tinker with that at all, or if that loses steam at all, that then impacts all the other parts of that business.
Yeah, I think the big issue, obviously for Amazon is going to be on the retail side of the business. On the cloud side, as Anurag Rana was mentioning, the spending is still there from their customers for the cloud space. It's just a question of, how long these tariffs go, and does that meaningfully impact overall economic growth, which would impact lots of businesses, including tech spending.
Yeah, and also if you just take a look at the Mag 7, for example, they had a great day yesterday, right? Because you had Microsoft, Google even delivered, Meta delivered, and then you had the consumer exposed guys like an Apple and like an Amazon getting hit, which also shows that big tech isn't immune. And I raised the question the other day, do we still need to think of these as Mag 7, or do we need to start actually distinguishing them? Like Tesla's its own beast, Amazon and Apple are very much exposed to the consumer. Do we need to rethink these things?
Yeah, the Bloomberg Magnificent 7 total return index down 12.25% to this year, up 25% on a trailing 12-month basis, but definitely having a tough 2025. And I'll call out for you again, WTI crude oil off almost $1 here, $58.30. Our friends in Texas and Oklahoma, they're getting a little concerned out there, I think.
Oh, yeah, and talk about tomorrow. And now that I learned the OPEC meeting has moved up, already OPEC Plus was going to pump 411,000 barrels of oil a day, which is 3 times as much as it did for April. So now what? ... This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it. Congrats. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. Every day we try and bring you this story pending news, and it's the Bloomberg Big Take. Big Take is amazing because it dives into very relevant stories of our time in a deep way that we can't do when we're just digesting the day-to-day news cycle. And today's Bloomberg Big Take has to do with satellites and them falling into the atmosphere. Well, I guess falling from the sky into atmosphere? Space into atmosphere? Something like that, right? You know what? Atmosphere. I'm clearly not the person to talk about this. Eric Roston is Bloomberg climate reporter, and he joins us on this Bloomberg Big Take story. So what is happening? Satellites falling out of space?
It sounds worse than it is. They're actually planned to. As many people may have followed over recent years, the more stuff we send up into space, the more crowded it gets, and the more likely it is that things will smash into each other and break, and you'll have screws flying around at 20,000 miles an hour, which nobody wants. So to avoid that, they made more concrete a practice that has been done for decades, which is deorbiting satellites and just having them burn up at the top of the atmosphere. And there's been no problem with that practice given the number of satellites we've been sending up in recent decades. The challenge is that we've quintupled the amount of satellites we're sending up just in the last few years. and that may quintuple several more times. The European Space Agency suggests that by next decade, we could have 100,000 satellites in orbit, which is an order of magnitude what we have now.
All right, here's something in your story. In 2024, there are about 1,000 satellite reentries, equivalent to 3 per day. That's just amazing to me. So they impact the ozone layer?
Well, that's the fear. So just to, as preface, one interesting thing about these kind of global environmental problems is like they're so big and they're like outside of our experience, but because like the planet itself is sort of almost simple system, you can make projections based on basic science of what's going to happen. And so what they're projecting here is that if this rate of satellite launches goes up, as satellites live their normal life of like 5 years, they're going to deorbit them, burn them up at the top of the atmosphere. Again, that's been largely fine till now, but given the numbers of satellites we're expecting to go up, the amount of vaporized satellite particles that hang at the top of the atmosphere, they could start to mess with atmospheric chemistry in a way we're unfortunately familiar with, which is it could start to launch ozone depleting chemistry again of a kind we saw in the 70s and 80s.
Oh, wow. So how many of these things have to sort of deteriorate to then cause any kind of real damage?
There's kind of two kinds of work that's going on now. One is analyzing what's been happening because of these satellites, and another projecting what'll happen as they grow. And so if you get a mature space satellite industry with tens of thousands of satellites going up every year, every few years, that's when you're going to start to get enough mass up there to really kind of change the chemistry of the atmosphere. And like, we don't talk about ozone all that much anymore because like we had the foresight to kind of fix the problem. But this kind of research is reawakening these questions we've fortunately put to bed, but may need to think about again in the future.
So just SpaceX, just Elon Musk's SpaceX alone, they've got 7,000 satellites in orbit already for their Starlink internet constellation. But the company said that they may have as many as 42,000 units aloft, but they only have a 5-year life expectancy. So isn't a company like SpaceX going to be almost every day shooting satellites up to replace the ones that are dying?
Yeah, every day satellites will go up and satellites will come down. And again, that's a successful policy decision that will lower the risk of this of space debris actually in orbit, sort of smashing into each other. But there's no such thing as a free lunch, and the downside is we may see chemicals at the top of the atmosphere that there's never been, water vapor, lithium, black carbon, all these things that high in the atmosphere before. And all of environmental law is predicated on the idea that pollution is going to be coming from the ground up. And so it's not like the entire edifice of environmental law isn't prepared for pollution coming from the top down.
So what do we do about this?
Fortunately, there's a lot of options because there's regulation that is possible. There are engineering solutions where reducing the number of metals or other elements that seem to be accumulating up there. But one thing the scientists emphasized is that we're catching this early. This is a problem we don't want to have. But again, because the nature of these planetary environmental problems is they're actually kind of easy to see coming in advance in some ways. We have time to look at this quickly and developing a very important industry. And and deciding what to do.
All right, Eric, thanks a lot. Eric Roston, Bloomberg climate reporter, joining us in the Bloomberg Big Take story. We really appreciate that. Check that out in the terminal and on Bloomberg.com. All right, for our listeners in the U.S., here is a reminder for you. Listen to us via satellite radio on SiriusXM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM channel 121 is presented by ShipStation. Stay tuned for the latest market news and industry research. Next hour, Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it through the week with the jobs number as the cherry on top. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great hour lined up for you. We're going to get the latest on the markets with Emily Rowland, co-chief investment strategist for John Hancock Investments, plus the latest what's moving. Vincent Signorella of Bloomberg. It's Friday, so it's Munis. Eric Kazatsky, Bloomberg Intelligence senior Muni strategist, will be joining us. I'm super fascinated on what these universities do if funding is pulled. Mike McKee will look ahead to next week's Fed meeting. And Brooke Sutherland, one of the best out there, Boston bureau chief, will talk more about Harvard losing its tax-exempt status. And then finally, my interview with Mike Wirth, the CEO and chairman of Chevron, reporting earnings today. But let's kick it all off for you right now with the Bloomberg Business Flash with Charlie Pellet.
Hi, thank you very much indeed. We got an A-plus lineup this coming hour right here on Bloomberg Intelligence. Stocks rocketing higher. Jobs Friday, we got you covered from multiple angles. The Dow, the S&P, NASDAQ, all surging right now, looking at a 73-point gain on the S&P, back at 56.77, up 1.3%. S&P, by the way, back at levels last seen before April's tariff shock. The Dow is surging 471, up 1.2%. NASDAQ Composite Index up 245 right now. That is a gain of 1.4%. The Bloomberg Mag 7 Index higher now by 1.3%. The 10-year 4.29%, and the 2-year 3.79%. Gold rebounding from yesterday's sell-off, up 21 now to 32.60, up 0.7%. West Texas Intermediate crude 58.36 a barrel, down by 1.5%. Bitcoin, meanwhile, closing back in on 98,000. Bitcoin right now 97,889. Bitcoin up by 1.5%. Job growth robust in April. The unemployment rate held steady, suggesting uncertainty over President Trump's trade policy has yet to have a material impact on hiring plans. Reaction to the jobs data from Tom Gimbel, the CEO and founder of job placement firm LaSalle Network, who is a guest right here on Bloomberg Intelligence.
Well, I think it shows that the U.S. economy is resilient. I think that the tariff hubbubaloo, for lack of a better word, hasn't hit yet. Companies didn't know what to do following the announcement the first week in April, so we have some time to show up on that. And I think the real message is small and medium-sized businesses always drive the jobs numbers more than anything else.
Tom Gimbel of LaSalle Network interviewed right here on Bloomberg Intelligence. Apple's much-awaited quarterly earnings report failed to soothe investor concerns about its biggest challenges, including escalating tariff costs and that slowdown in China. Apple today down 3.9%. Also reporting last night, Amazon, that stock now lower by 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Brokers studio and streaming live on YouTube as well. Green on the screen. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Vildana Heinrich. Vildana, what are you looking at?
I'm also taking a look at Amazon because it did say it's bracing for a tougher business climate in the coming months, which really is echoing those concerns that we've heard from a range of companies about tariffs, related economic turmoil, and how potentially it might crimp consumer spending. And when it reported results earlier this week, it actually posted a decent first quarter, but it said its operating profit in the current period would be weaker than what Wall Street analysts had been anticipating. And in issuing its forecast, it said its results may be materially affected by many factors, including tariffs and trade policies.
And
So
tariff was only mentioned once in their release, too. So you have to wonder, like, how much hedging there was around that. Also, let's take a look at Wendy's. So that stock up by 0.8%, but didn't they cut their forecast?
yeah, and I love talking about a company that maybe, you know, we use, or you can just stop by on your way home from work, get a Frosty. Its shares are up 1%. As of right now, maybe amid this broader rally that we're seeing, but it did lower its sales outlook for the year, and it's just the latest restaurant chain to take a hit from potential consumer unease about the shaky economic conditions. As we just mentioned, the U.S. is facing a challenging consumer environment, its CEO said.
Just looking at some reporting from MarketWatch, U.S. same restaurant sales, they fell for the first time since the height of the pandemic. That's interesting. I didn't know they'd been on such a strong winning streak. So something has changed, maybe. So in terms of the consumer.
Yeah, important to keep track of, you know, what these companies are saying about the state of the consumer, especially something, like I said, we can stop by on our way home from work and pick up a Frosty, but maybe people are doing that less and less these days.
Well, I mean, that's in some way discretionary, right? All right, let's go to Duolingo. I'm wrapping it up here. I mean, talk about discretionary. You would think that learning a language or using other tools, that would be discretionary, but that stock's up 16%.
Right, exactly. It's soaring today, and it's actually one of those stocks that is up for the year. It's up more than 50% for the year, given including today's gains. But it raised its full-year sales and profit outlook. It cited artificial intelligence offerings as helping to drive some of that demand towards its higher-priced subscriptions. Shares are up for the year, and subscriptions for its highest-tier products, which is called Duolingo Max, continued to grow, in part because of these new AI features. I'm a Duolingo user. If I can brag, I have a 1,827-day streak.
Oh my gosh.
Yeah.
What language?
In French.
Wow. So are you fluent now?
No, I wish I were. But I do try to take daily lessons. I do not pay for the subscriptions though. But it does seem to be working with some consumers. Some people are attracted to these offerings.
Working for you? Are you learning?
Yes, I'm definitely learning. Okay. Yeah, it's just taking a long time.
The CEO was just on Open Interest and said that to learn Chinese, you got to do like 2,000 hours. Wow. But it works. You just have to do it. And he was saying that basically a lot of people do it, but they don't finish it. And then that's where they don't get the real fluency. Except for Spanish, it was 500 hours.
Really?
Yeah.
Well, I'm at this streak where I can't stop. I can't go back to zero, you know, so I have to do a daily lesson for the rest of my life.
Internal competition. All right. Thanks so much. Really appreciate it. Bloomberg's Vildana Herrick joining us. For more conversations just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Looking at the powerful rally that we're seeing within the S&P, up over 1%. This would mark a 9-day winning streak for the S&P. We haven't seen a 9-day winning streak since 2004. Do you believe it? Emily Rowland is co-chief investment strategist for John Hancock Investment Management. Do we believe the rally?
Yeah, I mean, certainly we've seen some really positive developments here playing out. You know, not only is U.S. Earnings season coming in at about 13%, which I think is much better than expected here. Analysts have yet to revise their 2025 estimates down significantly here. And I think markets are responding to the potential that we've seen peak uncertainty as it relates to tariffs. Still a lot to understand and a lot of developments yet to come on that front. But really this idea that sort of the worst of it is behind us on that front. And also you're getting some pretty decent hard data. Everybody's sort of like holding their breath, waiting for the hard data to catch up to the soft data. And I think today's labor market report provided more evidence that we're just not there yet.
So where do we go from here? I mean, I guess it's glass half empty, half full. I mean, we're still down 8 or 9% from the peak earlier this year, but boy, we're up 12, 13% from the bottom. So I don't know where we go.
I know, it was amazing to look back on the month of April and you're like, wait a second, we were down. It was basically flat on the month after some of the most significant volatility we've seen in some time. You know, I think what's happening right now is that markets are really trading on sentiment. They're trading on feelings, whether it's geopolitical uncertainty or general political angst or just really not knowing what's going to happen next. We always focus on the economic and the earnings backdrop. And right now, I'm not saying things are great from an economic perspective, But the hard data, things like initial jobless claims hanging in the low 200,000s. We look at high yield bond spreads that got to about 450 basis points, meaning that there was some concern there that maybe something more sinister was going on in the backdrop. Now we're down about 360 basis points. So the key things that we look at are sort of giving us the all clear from an economic perspective right now. I know there's still a lot of uncertainty going forward, and we're learning from this earnings season that companies are in really solid footing. Of course, they're going to need to contend with some of these challenges around tariffs potentially, but we're coming into this in a pretty good space. So we continue to, be constructive on parts of the equity market. We can talk about that. We also think bonds offer a nice opportunity here with elevated income potential.
So based on that, are we conditioned again to buy the dip? So we had this disastrous early April. Then earnings seem to be solid even with question marks. Retail's been buying the dip. So do institutional investors need to get back on that?
I know it does seem like this environment where people are saying one thing and doing another, sort of back to the sentiment data. We're hearing that there's all this bearish sentiment around the U.S. And it is, by the way, unbelievable to see how well non-U.S. equity markets are doing, even though earnings and economic data are holding in the United States better on a relative basis than they are overseas. You wake up every morning and the DAX is trading at a new all-time high and sentiment's just really accelerating in Europe. So yes, U.S. equities are starting to come back here, but international non-U.S. stocks are still outperforming the U.S. by about 20% this year. So we actually look at this dynamic in which U.S. high quality assets are sort of the baby that's been thrown out with the bathwater here on a relative basis, and they are starting to offer some value in our view.
So what do we do on the fixed income side here, Emily?
Yeah, so we're looking at every backup in bond yields here as, frankly, a gift. We like income here. When we look at the ag at around 450 is something that's really attractive. I know that there's a lot of fear around the potential inflationary impacts of tariffs, but there's also another narrative that's going on underneath the surface that's very much disinflationary. Just looking at oil prices now below $60 a barrel, that's basically like a tax break for consumers. We're looking at major shifts within the housing market as demand is slowing, unaffordability still a big issue. Mortgage rates are back up a bit here. We're seeing insurance costs extremely prohibitive. And then people are worried about their jobs. So they're not buying a new home at the same time that supply is increasing. Remember how we all sort of locked in those low mortgage rates during the height of the pandemic? Well, you were lucky if you did, I guess. And everybody sort of said they weren't moving. Well, that was 5 years ago, and stuff happens in people's lives. They get a job in another state, or a divorce happens, or some other kind of life change. There was also COVID hotspots that built up a lot that now have excess inventory. So at the same time that housing demand is slowing, supply is picking up. That is wildly disinflationary as well. And then just the kind of impact to global growth from tariffs, which is very negative. So we think all of those things could actually cause inflation to continue to slow, which means there's a lot of potential value here in fixed income at elevated rates.
I don't know, what do I have again? 2.75? Something like that?
That's amazing.
I gotta tell you, I ain't never moving though. Nothing could make me move, no matter what. All right, Emily, thanks a lot. Emily Rowland, Co-Chief Investment Strategist for John Hancock Investment Management. Yeah, like literally nothing could make me move. All right, let's get more on these markets and how to take all this data right now. Vince Signorella, Bloomberg macro strategist, who's also a recovering FX trader for decades. And I'm looking at a Bloomberg dollar index as around the lows of the year, which brings us back to the lows that we saw back in September of 2024. Is the path of least resistance still lower right now, Vince?
Yeah, no, definitely. I mean, we have not resolved this China situation with the United States. Everyone's a little bit excited because there's some talk of that there being a truce between China and the U.S., but talks haven't started. We're nowhere near the beginning of all this. There's still two countries digging in their heels, pushing back on one another. And as Besson said a few weeks ago, even if they get a deal with China, it's going to take 2 to 3 years to implement. So, the irrational exuberance, if you will, of the stock market at the moment, I think is just a little overplayed. And with that, I think that's the same story for the dollar. The dollar still has room to drop.
Wow, because I just wanted to get your sense, Vince, of because we do have the stock market bouncing back and retracing more than half of its sell-off here, but boy, there's still no love out there for the dollar. How often do those two things stay disconnected?
Oh my, it's really difficult to say because the dollar has so many things working into it as to why the dollar goes up or down. It's so not just an equity story or an investment story into, let's just say fixed income. I mean, you look at the major sell-off we're seeing in bonds this morning. That has a bigger story for the dollar than equities. When you look at the overall size of flows that move in investment funds, it's much larger in fixed income than it is in equity. So when you see this sell-off in treasuries, you're probably seeing something where people are moving money out of U.S. assets and into something else. Look at the big jump we saw overnight in the MSCI Emerging Market Stock Index, for instance, up over 2%. That's people betting on this sort of truce and trade with the U.S. and China. But then you look at crude futures, Alex, your wheelhouse, down 1.3%. Not obviously all trade related. There's OPEC, of course, involved in terms of supply-demand issues, but a big part of it right now is trade. And the oil traders are basically telling you, we're not buying this true story because we don't see global growth. We still see a glut in oil based on low demand and not really playing into this to this trade space. So many factors affecting where the dollar goes. It's really just not an equity story. I wish it were that.
Yeah, personally, that people just don't like us.
I mean,
selling the dollar.
Does this surprise you at all? Before we let you go, dollar yen, 140. We've bounced around there 3 times. Do we break below that? Like, how high can the yen really move?
I think that's going to be a tough story, especially if we still see yields come up. We're going to see real yields in the U.S. pick up with that spread. Inflation is higher, but it's relatively steady right now. So if we see a buildup or a pickup in real yields, it's probably not a good story for the yen. I think if you're looking at overall currencies, in my mind, I feel a little bit more comfortable buying Canada and buying Mexico and selling yen down here. It's gone a long way.
All right, I need the euro back to parity by September. So see if you can get that.
Good luck with that. It's not going to happen. I say no.
I wish you the best. Yes.
All right, Vince Signorello, Bloomberg macro strategist, Bloomberg News, joining us there. I'll be going to receive my paisans over in Italy for 10 days in September. I thought I was going to get parity, but I don't know. I guess not. I mean, you look at the euros here, 113.
I mean, the only thing you can get is if the ECB cuts more than the Fed.
Right.
But with the Goldilocks jobs number, you kind of make an argument of why would the Fed at this point need to cut.
What did you make of Chevron and Exxon's numbers?
Ooh, okay. We're going to get to that also later on in the show. I think if you're a portfolio manager, it's really hard to own a lot of oil stocks. So you got to make strong decisions on which ones you want to make. Chevron has a lot going for it, but also some question marks. And one is, of course, paring back their shareholder distributions. But you also like to see that because they're doing sort of managing their capital, right? It's also underperformed Exxon. So you could say that there's more valuation makeup than Exxon, which may be fully valued. Some analysts are more neutral on Exxon and more positive on Chevron, but the big overhang is this Hess deal. If the Hess deal goes through, that could be accretive right away. That's what the CEO told me. If it doesn't, it's just going to be rough. They're going to tout their Gulf of America assets, as they call them, but it's still going to be rough without that access to Guyana and the massive amount of oil that they have there. I'll stop there because we'll have more later on in the show. You have equities on the highs.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg Jobs Friday. We have got the Dow, the S&P, NASDAQ all advancing. S&P back at levels last seen before April's tariff shock. Also, we've got signs of a thaw in U.S.-China relations, emphasis on thaw. The S&P up 67 now, up 1.2%. The Dow is advancing 392, up 1%. S&P, by the way, holding close to session highs. NASDAQ up 231 for the NASDAQ Composite Index. That is a gain right now of 1.3%. 10-year 4.30% with the 2-year 3.80%. Spot gold is up $15 the ounce, $32.55, up 0.5%. West Texas Intermediate crude down 1.6%, $58.31 a barrel. And Bitcoin right now up 1%, 97,455. So what about this morning's jobs data and the outlook from here? Emily Rowland is co-chief investment strategist at John Hancock Investment Management, and she was a guest right here on Bloomberg Intelligence.
You're getting some pretty decent hard data. Everybody's sort of like holding their breath, waiting for the hard data to catch up to the soft data. And I think today's labor market report provided more evidence that we're just not there yet.
Emily Rowland of John Hancock, interviewed right here on Bloomberg Intelligence. Oil company earnings, we'll have a lot more coming up right here. We've got Chevron up after earnings by 0.6%. ExxonMobil after earnings down 0.4%. And again, WTI down by 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. There you go. Eric Kazaksky joins us here in our municipal bonds segment, which we do every Friday. He's a senior municipal strategist for Bloomberg Intelligence down there in Princeton, New Jersey. Hey, I tell you what's getting my attention, Eric, in the municipal market. I'm seeing some big name universities talk about maybe coming to the municipal bond market to raise capital to maybe shore up their balance sheet, their finances, and what could be some pretty substantial reductions in federal funding. Yale, for example, weighs an $850 million bond sale. How does your market view some of these colleges and universities as credits?
Yeah. Hey, thanks for having me. Look, as always, those are credits that are always welcome in our market, right? AAA credits, brand names in the Ivy League space, credits that are really known to exempt investors, but more importantly to taxable investors, because, you know, the big Ivies, Princeton, Stanford, Harvard, Yale, they access both markets, and overseas investors are still clamoring for very high grade U.S. denominated fixed income assets, and that is going to be one of those names, and they do have a little bit of taxable money coming with that deal as well.
How much issuance do you think we're going to see from universities? Like, how do you model that out?
Yeah. You know, it's really hard to tell. Look, I think as rates come down, you're going to see a lot more issuance come to the market in a favorable rate environment. But also there's a lot of rhetoric and a lot of threats coming from the White House right now in regards to taking away the tax exemption. You know, certainly something, you know, for higher education that is a lot simpler to say than it is actually to execute on. But, you know, you could see a little bit of rush to market just to get ahead of some of that, you know, perceived volatility in the market. And that really could be some of the timing you're seeing with Yale coming out with a deal that large right now.
I know you did some work with Andrew Silverman, BI's tax analyst, thinking about this tax exemption status for universities. What did you guys conclude here? Is that a real risk for some of these universities?
You know, we think that the real risk is probably, you know, raising the endowment tax on these universities, right? As they sit there with, you know, tens of billions of dollars, it really seems like sort of low-hanging fruit and an issue that really could get bipartisan support. And, you know, at the end of the day, cost them several $100 million in extra tax, right? Really, no one is really harmed by that fashion. But we did sort of like tease out, you know, what would happen if the exemption did go away for some of these larger universities? And, you know, the fact of the matter is, like I mentioned earlier, the corporate market is already sort of welcoming these credits with open arms, right? So if they went completely taxable, the market has already sort of been tested on that side. So there's really a clear path for them.
So in theory, losing that status should be fine? Like they can manage it, they just get it in a different kind of way?
Correct. Obviously, their borrowing costs will go up on what they're missing out on the exempt side. But, you know, we think that the more money that comes in as far as issuance on the taxable side, it's going to find a home and still at cheaper levels than, let's say, a similarly rated corporate would be.
Interesting.
How are the flows in the muni market these days, Eric?
Coming back to life. You know, like last month, and I would say the last 6 weeks have really sort of been touch and go. And we sent a note out the other day just sort of looking at how April was really sort of a story of two separate months, right? The first half of that month, muni returns, especially in the high yield space, were down almost 3%. The back half of that month, if you sort of just came back to the market on the 15th, you know, you were up almost half a point. So, you know, really we're starting to see positive momentum build back in. ETFs are showing a little bit more signs of stability in life. So all things that we want to see going into the technically heavy part of the year.
What other cool things are happening in your market right now? What's on the radar?
I mean, I think the coolest thing that we could probably put our hat on is the fact that the threat of the exemption wholesale going away is finally behind us, right? So we could sort of, you know, stop worrying wholesale about all our, you know, business and jobs going away as far as municipal specific industry. So I think that's a really good thing. And I think it's just about time to sort of get back to basics and figure out how we're going to sort of get all this financing back on track.
So has that officially been shelved, the tax exempt for municipal securities?
I mean, it seems like it's pretty shelved at this point, right? You know, obviously anything can happen, or a tweet could come out, or something posted on Truth Social to send it the other way. But, you know, as far as we're concerned, the threat is certainly minimized at this point.
All right, Eric, thanks so much for joining us. Really appreciate it. Eric Kozatsky, Senior Municipal Strategist for Bloomberg Intelligence. He's down there in Princeton, New Jersey. And why wouldn't you be? They have great breakfast, great lunch, great office. All good stuff here. We had some economic data today. I think just the long and short of it is, if you look at the change in non-farm payrolls, pretty darn good this month on the surface. Yes, the prior month was revised downward pretty materially, but you know, if you're Fed Chairman Jay Powell, I don't know. I'm going to just sit on my hands, I guess. But we'll talk to somebody who knows what's going on here. I mean, you have to. You got to go to the smart people here. So we're going to go. What do you want to talk about here?
Mike McKee.
Mike McKee. And Mike McKee.
There's a smart person, but where is he? He's not in the room. No, I'm kidding. Michael McKee, Bloomberg, International Economics and Policy Correspondent, as you're searching for it. Is this a Goldilocks report for the Fed for next week?
I don't know if I would use the word Goldilocks, but it confirms that there's no reason to do anything that to respond to this report. I suppose you could say it's just right in that sense.
Are you surprised that that we had a pretty good print? Because I think the whisper number was probably 120, you know, for a miss.
Yeah, Wall Street was leaning towards a weak report, and the zeitgeist has been that things are going to get weaker because of tariffs. But the survey week for this jobs report was the week after the president announced his Liberation Day tariffs, and it encompassed the week that he walked them back.
Yep.
And basically the consensus out there, which I agree with, is that it was too early for companies to react. I mean, they were shell-shocked for a few days, and then the walk back just made it worse in the sense of you don't know what's going to go on. So we'll be waiting to see what the impact is when we get to the next month, when we get to June and see the May figures.
So I was looking at WIRP after the numbers, and it looks like a full cut is now priced in just for July. It was moved up a little bit before that. Does that track with what you're hearing from Fed officials? Because if everything's Goldilocks, why not cut?
The basic message from Fed officials is we don't have a time frame, and I've sort of stopped paying attention to the Fed funds futures trading because it just moves around on headlines at this point. It's not based on any fundamental analysis of the economy because you can't do a fundamental analysis of this economy. How do you figure out what's going to happen next if you don't even know what the president's policies are? I go back to what Chris Waller said to us a couple of weeks ago, that you probably won't have solid enough data to see which way the economy is going until at least July. And as he pointed out, the 90-day delay on tariffs doesn't end until the first week of July. So you won't even know what the tariff update is going to be until then. So he was looking to the fall for some kind of, if they were going to move one way or another.
Average hourly earnings hanging right in there, Mike. It's, you know, up 3.8%. That seems like a healthy clip.
It is. It's about what the Fed thinks is consistent with a 2% inflation rate. It has been slowing, but so has the overall labor force, but not so much that it gives you the impression that things are falling off a cliff or things are not doing well. So
have we seen any impact from the fact that the border seems to be effectively shut down a little bit? I mean,
not yet. The number of foreign-born workers in the labor force rose a little bit. Not a big deal. And if there were going to be a profession that was affected fairly quickly, it would be construction, but construction added 11,000 jobs. So it doesn't look like that has had an impact yet. Now, again, all of the economists who, like me, were wrong in their thinking that we might see a relatively weak report, not a bad report, but everybody's saying, well, this is the calm before the storm, and that we're going to see things deteriorate going forward. And it's hard to see how they don't. I don't know if you caught Gene Soroka this morning when he was on and saying that all these ships are not coming to the port of Los Angeles, and he thinks we're really going to have huge problems. I mean, there's a guy on the front lines.
Yeah.
So
I mean, he had a stat. He was on surveillance with us. He says his bookings or sailings for next week are down 30% year over year. So that now they're starting to see it. I mean,
and I think basically anything you get that you would buy in the store from China is going to be in short supply very soon.
That's interesting. Well, what else are you looking at? What else is on your radar?
Well, we do have the Fed meeting next week, and we'll get a little bit better picture maybe from Jay Powell about how they're thinking about things going forward. There's no economic forecasts associated with this meeting, and they're not going to change anything in terms of rates. So we'll look to that. And then there is a meeting out in Stanford, California, at the Hoover Institution.
You go to that?
I'm going to that.
Yes.
It's an honor this year of John Taylor, whom we all know of Taylor. And there are a number of Fed officials speaking at that on Friday, which is the first day they're allowed to speak after the blackout. The good news is maybe we'll get some idea of what the rest of the Open Market Committee is thinking on Friday. The bad news is it's at 7:45 p.m. Eastern time. So bring your radio or your Bloomberg streaming service out to the Hamptons. And
I'll just wait for my emails from you, and you can tell me what that matters.
I'm sure that'll go over well at your house. I'm sorry, it's Friday night, guys. I'm going to go read emails from Mike McKee about what the Fed is saying.
Cool. Mike, thanks a lot. We appreciate you. Michael McKee, Bloomberg International Economics and Policy Correspondent. He texts and emails me all the time. I just may not listen
It's
Friday
a special
night.
secret text list, because I don't think that's broadly disseminated.
No.
I think you're special.
It's a special. It's clearly.
It's on
obviously.
Signal. Yeah, I mean, the only people, if you're in the National Security Council,
Too
you
soon?
can get it.
Okay. All right, coming up, we are going to talk to Brooke Sutherland. She's Bloomberg, a Boston bureau chief. She's also an amazing reporter when it comes to industrials. But this is on the news that President Trump says that Harvard will lose its tax-exempt status. We're going to break down what that means for her. She also has her newsletter out every Friday, and today she's talking about toothpaste versus factories. Basically, if you sell to other factories, you're buying stuff. Yep. If you're selling to toothpaste manufacturers, you're not selling anything. And that doesn't really make any sense. So she's going to help us break that down as well. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and eToro Group considering launching its U.S. IPO as soon as next week after the trading and investment platform paused its listing plans amid tariff-related stock volatility. Again, the headline right now on the Bloomberg Professional Service, eToro said to be launching its U.S. IPO as soon as next week. Stocks pushing higher, the Dow, the S&P, NASDAQ, all close to levels last seen before April's tariff shock, thanks to strong jobs data and signs of a thaw in U.S.-Canada relations. Right now, we've got the S&P holding close to morning highs, up 71 now, up by about 1.3%. The Dow up 1.1% higher by 451 points. The NASDAQ Composite Index up 241. NASDAQ now higher by 1.4%. And the Bloomberg Mag 7 Index up 1.3% this after earnings from Apple and Amazon. Both of those companies are lower. Apple right now down 3.8%. We've got Amazon down 0.4%. 10-year 4.29% with a 2-year 3.79%. Gold little changed on the day, down $1 the ounce now, $32.38. West Texas Intermediate crude down 1.8%, $58.19 a barrel. America's economy added jobs in April, even as tariffs weigh on businesses big and small. And with that story, here's Bloomberg's Vinny Del Giudice.
It's a respectable showing, even a bit higher than last year's monthly average. Employers added 177,000 jobs, a sign the labor market hasn't buckled as White House policy sows confusion and dents confidence. Manufacturing payrolls did show a small loss, though. April unemployment held steady at 4.2%, even with federal government job cuts. The underemployment rate, which tracks people settling for part-time work, dipped. Vinny Del Giudice, Bloomberg Radio.
On an update for stocks, a couple of prominent decliners. Take-Two Interactive Software has pushed back the release of Grand Theft Auto 6 to next year. The stock selling off today. Take-Two down 6.4%, and shares of Block Inc. down the most in more than 5 years after the digital payments company posted first quarter results below analyst estimates. XYZ on the ticker. The stock now down by 21.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thanks very much. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also have an amazing bench of reporters as well as bureau chiefs that we like to tap as well. We're going to go to one of them now, Brooke Sutherland. She is the Boston bureau chief, one of my favorite people, one of the smartest people that I've ever met. So the headline for Boston is that President Trump has announced that Harvard University would lose its tax-exempt status, and that threatens to revoke the school's financial benefits. Brooke, what's the vibe in Boston right now?
I mean, I think the vibe is not great. I think there's a lot of concern about not just what happens with Harvard, but what happens with some of the other funding cuts, specifically around the NIH. I mean, this is an economy that really thrives off of its higher education institutions, its top-tier hospitals, and its research facilities. And these organizations support a much broader ecosystem that is very linked to Massachusetts employment and the overall health of the state economy. And so this is an issue that state politicians have really, rallied around Harvard for, in terms of just really pushing back on this and trying to protect those interests that are key to their economy. We've even seen, the Republican candidate for governor coming out and advocating for the funding that goes to some of these institutions and the important role that they play in the Massachusetts economy.
What's the feeling, Brooke, as to the legality of such a move? Does the president have the legal authority to do so?
It's still not clear at this point whether or not his comments this morning about revoking Harvard's tax-exempt status actually came in conjunction with a directive from the IRS or from him in particular. It's not clear exactly sort of what steps are being taken or where we might be in any kind of process. Now, typically, the IRS standards prevent the president from interfering with federal tax agency decisions. And so this is undoubtedly something that if the administration were to proceed with revoking Harvard's tax-exempt status, that you would likely see the university challenge that. And it's a process that would take years to play out between appeals and negotiations over what might happen here.
So the dum-dums like me are going to be like, what's the big deal? They have a big endowment. They charge a lot to tuition. Like, why do they need the status? And what's the actual argument?
So the endowment is helpful, but you can't really use it like an ATM or a piggy bank. The funds that are in there are mostly earmarked for certain programs, scholarships, certain schools, and so they can't just use that money as they wish to plug whatever gaps that they might have. Harvard is certainly in a better position to weather this storm than a lot of institutions. It's one of the oldest in the country and also the richest. But I still think the financial toll of this can be really significant, and it can affect how the university doles out financial aid. If they're not tax exempt, they would also have to pay property taxes. They have a lot of real estate, not just in Cambridge, but also in Boston proper. And that bill alone would be extremely substantial.
And stripping Harvard's tax-exempt status would deal a significant financial blow to the university. This is in the Bloomberg reporting, which receives an estimated $465 million in tax benefits annually. And it's not just Harvard. Brooke, looking at your reporting here, some 1,700 private colleges operate as nonprofits. Given their contributions to society, they receive that benefit part of a section of the Internal Revenue Service tax code, which specifically mentions education as being a purpose that can receive the exemption. So I'm guessing pretty much every private college and university around the country, Brooke, is looking to this Harvard case.
I think they definitely are. I mean, I think there's a question of whether, the administration is particularly targeting Harvard because it is so well known and so prestigious in terms of trying to effectuate some of the change that it wants to see on college campuses. It's sort of making a model out of Harvard versus some of the other universities in the country. But certainly, I think they are watching this very carefully. And if they're not, directly connected to this particular fight or going to see their own tax-exempt status called into question, they're likely feeling the pressure of the funding cuts because NIH funding does not just go to the Harvards and the MITs of the world. It also goes to a number of other universities spread out all across the country that are doing, very important work to advance U.S. competitiveness in things that we've decided are national priorities. Things around national security, around medical advancements, semiconductor research. I mean, this all takes money, and historically, that's a role that the government has played in supporting that research and innovation.
Brooke, before we let you go, I also touted your expertise in the industrial industry. You've covered the industrial industry for a very long time. You have a weekly newsletter that sort of picks up on all the little details happening within that very important space. And in your piece today, you talked about toothpaste versus like basically factory orders. Can you give me the takeaway from that? 'Cause I thought it was quite interesting as how we're looking at the economy.
Sure. I mean, I think there was a lot of concern heading into this earnings season about what we might see from the manufacturing economy. The thinking being that was sort of the front lines of where tariffs would hit. And these companies are certainly, expecting an impact, but by and large, they're mostly doing okay. I mean, the demand in the first quarter was very strong. And so far, companies really aren't flagging any kind of material step back or, some sort of serious pause in projects. It's a very different story on the consumer side of the economy, though. I mean, you've seen airlines pull their guidance because of a pullback in travel demand and concerns about consumer confidence. You've seen companies like Colgate-Palmolive, which makes toothpaste, with sales dropped about 3% in the first quarter, in part because customers are trading down from premium toothpaste options to sort of middle tier options. And that trade down effect is manifesting, in a number of different places across the consumer economy. And I think, it's just interesting. There was an argument a few years ago about could you see sort of a decoupling of the manufacturing sector from the rest of the economy because there are sort of secular reasons driving construction of new factories, whether it's reshoring or some of the energy initiatives that we've had, all of the government stimulus around infrastructure and semiconductors. That didn't happen. And I think it would be extremely difficult for that to happen again in an environment if we do see tariffs really dampen consumer confidence and really cause that consumer to pull back on spending. It's hard to keep industrial equipment orders going along at a robust place when people, can't afford sort of basic needs.
All right, Brooke, we really appreciate it. Thank you so very much. Brooke Sutherland, Boston Bureau Chief and Industrials Expert right here at Bloomberg. All right, from her world to my world, and that's big oil. Chevron stock is up by about 1.3%. It cut its buybacks in the last quarter, but had some really good news, especially when it comes to some of its offshore drilling in the Gulf of America, as it talks, as it says. Exxon sitting pretty tight as oil plunges, not really messing with its buyback program as well. Chevron reducing its buyback this quarter to about $2.75 billion, 30% less than in Q1. I had the pleasure of sitting down with the CEO and chairman of Chevron, Mike Wirth, earlier, and we talked about those buybacks and the potential upcoming arbitration as it relates to Hess.
We're growing production, as I said, we're growing cash flow. As we move into next year, our break even to cover the capital budget and the dividend will be down in the low 50s. We get beyond that, it'll move into the 40s. And so if you pick any given quarter and do some of this math, you might reach a certain conclusion. As we look forward into the next few years, our break even will be low and going lower.
Let's talk about the next few years. And a big part of that will be the purchase of Hess. Finally, you get a date for arbitration hearing for the end of May. You've had a chance to look at each other's cases. How has your confidence changed?
Well, it really is unchanged, Alex. The contract is very clear in the language of the contract that will be applied in the arbitration, and we've steadily believed that the Hess side of this argument is the proper side of it. And so as we move closer to the date of the arbitration hearing and then a decision 3 months after that, our view really is unchanged. We feel very, very confident that Hess will prevail here.
Obviously, Guyana is a huge asset and would be so great for Chevron. So how quickly could that be accretive to you guys? Like, what would that integration look like?
Well, we've had plenty of time to prepare for
Yes,
integration, and so the teams have been working closely, and we're ready to move very quickly to integrate the two businesses. So once we get a decision, that can happen in a matter of days and weeks, not months or years.
Part of that also was you buying 5% of Hess shares on the open market. Two thoughts, and they're two very different thoughts. One is it just shows how much confidence you do have in the deal. The other thought is that it won't go through and you still want a seat at the table if the deal fails. Help me understand which side.
Well, the shares were trading at a discount to the value that we would exchange our shares for in the transaction, and so it made it economic just on the surface. We do have confidence, as I just expressed, and so that's really what sits behind that decision. It's a good company. Hess's performance has been exceeding expectations every quarter, really, since we announced this transaction. The business is being run well. Their stock has we viewed it as a good investment back then. We view it as a good investment today.
That was Chairman and CEO Mike Wirth joining me earlier on earnings. And just for a recap, Chevron made a bid to buy Hess. Hess accepted. And then Exxon came in and said, no, we have right of first refusal to Hess's project in Guyana, which is a prolific oil region. And they've been in arbitration for quite a long time on that. We may get a final result later on in this year. Vince Piazza heads up all our oil and industry coverage for Bloomberg Intelligence and joins me now. Vincent, what do you think of the answer that, nope, they got complete confidence? If Chevron doesn't get Hess, what happens?
Well, look, if Chevron doesn't get Hess, then someone of size would need to make a move on Hess, right? Exxon suggests that it has these preemptive rights. And so if the arbitration goes in its favor, there will be a decision that needs to be made about that value and what that value is. And I would suggest to you that because of Hess's size, the number of suitors for Hess, whether it's the asset or the entire entity, is quite limited. And you need someone that has the heft, the balance sheet, the flexibility, the financial flexibility
an ExxonMobil. And so I think both entities have a solid case to be made. I've never heard of an acquisition being held up because of a shared asset. But you know, a lot of strange things have happened in the world in the last year or so. So we'll see what happens. But I think if you take a look at just the earnings from today, guys, I think it's obvious that Exxon is pulling away, both operationally and financially. And I think that if you were to take a look at this a year from now, you would see the ongoing strength of the Exxon operations and Exxon's financial health.
Right. So, hey, Vince, you've been covering these big oil companies, integrated oil companies, for years here. What are they telling you about life at below $60 a barrel, around $60 a barrel for WTI crude?
You know, life is sustainable when you have solid balance sheet and you have the financial strength. And in this case, you have ExxonMobil, which paid back roughly $5 billion of debt. Balance sheet leverage is very, very manageable. They have the financial flexibility to push forward. Financially, they threw off about $9 billion of free cash flow, 8.8 to be exact. The cadence of buybacks remains the same. The dividend pace remains the same. So there is strength there in their confidence, in their decision to maintain those levels. Contrast that with what you heard from Chevron, and when you're throwing off roughly $1 billion of free cash flow, and you're trying to pay out dividends of 3 and do buybacks of another 4, the math doesn't compute, right? And so that pretends the decision to scale back the buybacks closer to what, 2.5 or 3 billion for 2025. Hey, look, you know, operationally, Exxon's in a strong position, especially in Guyana, especially in the Permian. You have Yellowtail likely coming on sooner than expected, most likely in 3Q. That's 250,000 barrels a day of gross capacity on a resource that has potential of well in excess of $6 billion. So you could understand the attraction for both Exxon and for Chevron. And, you know, Exxon's in the driver's seat there. You have also for Exxon the Pioneer acquisition, the Permian Basin, which remains a strong, low-cost avenue for growth. So I'm not really concerned here if this dips below the $60 barrel range, especially when you have the balance sheet strength to push through that. Now, 15, 20 years ago, the economics were different, right? Leverage was a bigger source and also a bigger source of pain for these organizations as well. But for the most part, a lot of these names have gotten their balance sheets in the right size and the right shape. Maturities are quite manageable in 25 and 26. So I don't see the pain coming from any type of balance sheet event. And for the most part, what we're telling the operators is, let's manage that production. We want to see the free cash flow being thrown off. We don't want this excessive accelerated growth that we saw during Scale 1.0. We're in a different situation here. It's a mature industry. What we do want to see is much more capital discipline. And it's fine if you want to go out there and pay for an asset using your currency, using you for equity, because your equity is valued higher than what a private equity sponsored company may be. And you can consolidate, integrate, and actually increase free cash flow going forward as well.
All right, Vince, thanks a lot. We really appreciate it. Vincent Piazza, he covers all the oil companies, E&Ps, as well as the big guys for Bloomberg Intelligence. We appreciate all of that insight. Shameless plug. You can check out my full Chevron interview on the Bloomberg podcast page on YouTube. It's also available on Bloomberg.com, and you can also check it out on the terminal as well. Shameless plug. I did it. Yeah.
How good is that?
Yeah, so fun. Not so much when you look at the oil price. Watch that OPEC meeting tomorrow. That's going to be fun. Wraps it up for me and Paul. Balance of Power with Joe Matthew is up next after this Global News Update.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. Shrugging off tariffs and sagging consumer confidence, employers kept on hiring last month. The government says 177,000 jobs were added on. CBS's Kelly O'Grady.
This is a good report, but there's sort of an asterisk for me as I was reading it that there's a lot of different places where you could see pullback over these next few months if we don't get trade deals.
CBS's Jim Krasula has the latest math on home ownership.
Looking to buy a home, you'll need to earn at least $114,000 a year to afford a $431,000 home, the national median listing price last month. That's according to data from Realtor.com. The earnings figure is nearly $50,000 more than just 6 years ago, when the median U.S. home was listed for $315,000.
The CDC reports more children have died from the flu this season than at any time since the swine flu pandemic 15 years ago. 216 deaths reported. For a second time, President Trump vowed on social media to strip Harvard University of its tax-exempt status. The schools resisted administration efforts to force leadership and admissions changes. Legal contributor Jessica Levinson says a court fight is likely next.
If Harvard felt that its tax-exempt status was targeted because of its educational content or its ideological views, it could argue that that actually violates the First Amendment and that it amounts to government retaliation based on ideological content. It could also argue that that violates the Equal Protection Clause, that that's an arbitrary or discriminatory enforcement of the rules.
Now to London, where CBS's Holly Williams says Prince Harry lost a court bid to have his royal security restored when he visits the UK.
After losing that appeal today, Harry's only remaining recourse is to try and take his case to the UK's Supreme Court, which is an extremely high bar legally.
Comic performer Ruth Buzzy has died at 88. CBS's Stacey Lynn.
Ruth Buzzy appeared on popular shows in the 60s, including The Gary Moore Show, The Monkees, and That Girl. Her big break, though, came on Rowan and Martin's Laugh-In 1968. She was one of only 4 cast members who were regulars for its entire 6-season run.
Boy, you can't trust anybody these days.
Her most famous character was the spinster Gladys.
It was a fun, easy character to do.
After Laugh-In, she starred in several TV shows, including Saved by the Bell.
Wall Street, the Dow is up more than 500 points. This is CBS News. In just 5 days, we'll need real ID to enter some government buildings or board a flight. A passport will still work. But CBS's Chris Van Cleve says the TSA is braced for possible delays and confusion.
The TSA says about 1 in every 5 flyers is showing up without a compliant ID, meaning they could be in for major travel troubles when the real ID requirements kick in on Wednesday.
We're all hands on deck.
Adam Stahl is acting as the deputy TSA administrator.
We're very confident that we can
thread the needle of both enforcing the law while also minimizing impacts for folks.
TSA officers will use a secondary process to try to confirm the identity of flyers without a real ID, passport, or other compliant identification, but that can take time.
Next week's Papal Conclave is coming up, and a chimney has now been installed in the Sistine Chapel. That's where smoke that emerges from it, white smoke, will signal a choice has been made. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The round trip is complete. Welcome to the Friday edition on this Jobs Day, with markets now on track to make up for all the lost ground following the freakout over tariffs. Stronger than expected jobs today, and a new headline from the Wall Street Journal: Beijing weighing a fentanyl offer to the U.S. to start trade talks, and markets are kicking up on this. We'll be joined ahead by Bloomberg Economy's Stuart Paul on the jobs data, as well this hour by Bloomberg's Washington editor Wendy Benjaminson, with President Trump now saying Harvard will lose its tax-exempt status. Later this hour, our conversation with Mallory McMorrow. You're going to want to hear this. The Democratic Michigan State Senator is running for U.S. Senate and will join us straight ahead. It's all after a look at Wall Street. Let's get to the markets right now. New highs for the day, and Charlie Pellet's got the story in New York. Hey, Charlie.
Well, hello there, Joe Matthew. As you correctly point out, stocks getting an additional boost from the headline that was on the Bloomberg just moments ago. Beijing weighing a fentanyl offer to the U.S. to start trade talks. That headline from the Wall Street Journal. But again, right now, we have got the S&P taking a leg higher, up 92 now, 56.96. That's where we stand, up by about 1.6%. S&P 500 index, by the way, on track for its longest winning streak in over 20 years, driven by strong jobs data and progress on international trade talks. The Dow up 592, now up by 1.5%. NASDAQ up 325, up by 1.8%. The Bloomberg Mag 7 index is advancing now. That index up by just about 1.8%. The 10-year, 4.32%, with the 2-year, 3.82%. Gold now lower by $9 the ounce, 32.29. That is a drop of 0.3%. And West Texas Intermediate crude oil down 1.6%, 58.29 a barrel. So the jobs report out this morning. Reaction from Stephanie Roth, chief economist at Wolfe Research.
It was a strong one. Granted, we had some downward revisions to the prior month, but the net trend is pretty strong. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months, and if we don't get a significant downward shift in the tariff rate from China, then things like the strength in transportation and warehousing is gonna very much shut off.
Stephanie Roth of Wolfe Research, and of course we'll have more on this morning's jobs report coming up with our Stuart Paul in just a moment right here on Balance of Power. After earnings, Apple shares are moving lower. Apple down now by 3.7%. Apple getting at least 2 downgrades today. Also reporting earnings last night after the close of trading. Amazon up now by just about 0.6%. So again, U.S. stocks higher. And let's repeat the headline that we brought you moments ago. Beijing weighing a fentanyl offer to the U.S. to start trade talks, that according to the Wall Street Journal. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much for walking us through it, Charlie, and happy Friday. If you're with us here at high noon in Washington time, you know there's going to be news breaking, and that certainly is the case again today with the redhead on the terminal. We'll keep tabs on stocks here, and as we learn more about what Beijing is reportedly offering, we will let you know. You made it to the threshold of the weekend, and thank you for being with us here on the Friday edition of Balance of Power on Bloomberg Radio, satellite radio channel 121, and YouTube. Dial us up, search Bloomberg Business News Live, and we'll have a seat for you saved in the studio. We've got a lot to go through today. When it comes to economic data, of course, it's jobs day, and that's driving things along with the uncertainty, or maybe we just got a glimmer of hope when it comes to the tariff story and trade. But it's a conversation day here with lawmakers back home. The president has left the bubble, and we're joined live from New York by Stuart Paul, the U.S. economist for Bloomberg Economics, on a jobs day that saw some pretty impressive numbers. Stuart, great to see you. We keep hearing that at some point the impact of DOGE layoffs of federal workers is going to show up in these reports, the uncertainty that could be dampening hiring because of tariffs, but I guess just not today.
Well, if you read below the fold, if you flip to page 10 of the paper, maybe you start to see some tiny impacts of both trade policy and of DOGE policy coming through in the data. For example, there were 9,000 fewer federal employees showing up on payrolls. We did see, for example, hours of construction workers that were cut back. But across the board, if we think about actual headcount expansion, the payrolls report today was very favorable. As we think about the household survey side of the report, of course, the Bureau of Labor Statistics asks households how many people are employed. They ask businesses how many people are on their payrolls. When we think about the household side of the report, a heck of a lot more people reporting that they're employed. The unemployment rate staying at a relatively low 4.2%. All of the headline numbers across the board are favorable for the Fed ahead of its meeting just next week.
The relationship between soft data and hard data is getting to be a little bit complicated here. And I want you to hear the take from the White House on this. We heard earlier on Bloomberg TV and radio Stephen Myron, chairs the U.S. Council of Economic Advisors, one of the president's most important economic voices inside the White House. Here's what he said.
There's been an ongoing disconnect between the hard data and the soft data, and the hard data continued to perform very well. 177,000 jobs last month, a beat of 40,000 jobs. That's the president's second jobs day beat in a row. And on top of that, you've got 11,000 construction jobs, expanding construction sector in spite of the president's crackdown on the border.
Okay, so a couple of things there, by the way, referring to, I thought this was Biden data. It's the White House has been saying. It just says that was Trump's second beat. But let's get to the actual matter at hand, Stuart. Will the soft data catch up to the hard data, and when?
I think that consumers, I think that businesses, when they're surveyed, are going to remain relatively pessimistic. I do want to pick on Stephen Myron just for a second when he pointed out that 11,000 additional construction workers were added to payrolls despite the tariffs that were put in place. We did see a decline in aggregate hours worked in the construction industry, so there's less worker intensity despite the increase in headcount. And as he pointed out, maybe this is downstream from immigration policy, we did see a material increase in native-born employment and a decrease in foreign-born employment. So construction might be one of these vectors in the payrolls report where you're just getting a rotation toward documented workers artificially buoying the payrolls. Now, that's a very technical thing, but to the extent that workers are experiencing some sort of a boom in demand for labor on this great day where we saw 177,000 jobs, it might not be as material of an effect in terms of workers' experiences, in terms of demand for labor. It could be just sort of a little bit of a rotation towards documented workers that are buoying the numbers. And so sentiment can remain relatively unfavorable because experienced conditions on the ground are not as good as the numbers might suggest. And I expect it to remain that way, especially with policy uncertainty so high.
Yeah, well, this is important. Now, as the White House trumps the data, pun intended, the other side of the coin, illustrated by Senator Elizabeth Warren. Stuart, she's out with a statement saying today's jobs data shows the labor market is still slowing down. In 3 months, Trump and his chaotic tariffs shrunk our economy and raised prices, slowed private sector job growth to its lowest point in 9 months, and pushed continuing jobless claims to levels not seen since the pandemic. Is she right?
I think that that's a particularly unfavorable reading of the data. I think, I think that if you look below the fold and you flip onto, maybe even page 10 of the paper, you start seeing some of the effects of policy decisions showing up in the data. I think that overall we are seeing a cyclical slowdown as consumers are stretched, as businesses are adjusting their investment expectations, their sales and revenue expectations for quarters ahead. I think that that's what's going on, is that this is part of a larger cyclical phenomenon that is being affected to some degree by this reorientation of the global commercial order. But to the extent that Trump's policies are to blame for a modest slowdown in the headline number of jobs added, I think is rather unfavorable. We would expect that from Elizabeth Warren. We know where she is, on what side of the political aisle. I think that if there were to be a more precise critique of the data, and if we could infer anything about the future from it, it's that wage growth slowed, average weekly earnings slowed, average weekly earnings growth slowed, and if we're looking out to personal income growth for the month of April, it's likely to just be about 0.3%, which is pretty cool. It's not the sort of thing that's going to support real spending growth for the year ahead, and that would be the thing that's more troubling. It's uncertainty weighing on hiring, earnings, and spending plans.
Well, you heard the two polar opposites there, the view from the White House, the view from Elizabeth Warren. The fact of the matter is, Elizabeth Warren and Donald Trump agree on one thing. They both think the Fed should be cutting interest rates. If we didn't have this tariff overhang right now, if none of that concern was in the water, and you look at the actual hard data we have, would the Fed be cutting?
It would be a pretty close call, because right now we do have the inflation data in hand that would allow the Fed to cut by a quarter point, for example. But on the employment side of the Fed's mandate, hiring is still reasonably robust. Unemployment is still low at 4.2%. And if anything beyond tariff policy would be affecting the Fed's thinking right now, it would be immigration policy and tax proposals. What we're going to end up seeing ultimately with the budget plan, tax proposal coming out of the West Wing. And both of those would point to more inflation pressures and a tighter labor market. So it probably would net out to the Fed remaining on hold, even if we were to remove everything in terms of trade policy. I don't think that the Fed would really be inclined to cut rates at this point.
Understood. Do we hear any new wrinkles at the Fed meeting next week? This is going to be an interesting time for the news conference, when we're talking every day about a different story on tariffs. Before we started the program, red headline, Beijing now weighing a fentanyl offer to the U.S. to start trade talks. The markets love this. We get to new highs for the day, but Jay Powell's just sitting there holding the bag while he's waiting for news.
That's right. I think that all things considered, all the news is going to be made out of the West Wing. It's not going to be coming from further down on Constitution Avenue at the Federal Reserve. I think that it's going to be a relatively boring meeting. No change in interest rates. We're not going to get any news about the Fed's balance sheet or the pace that it is normalizing its balance sheet. I think that anytime somebody asks about political pressure coming out of the West Wing to either replace Chairman Powell or to cut interest rates, Chairman Powell is going to stay mum, and he's just going to say that he's going to keep doing his job while he's in the post.
We'll find out together next week with special coverage of the Fed meeting and the help of Stuart Paul. It's great to see you, Stuart. Thank you, and have a great weekend. U.S. economist, Bloomberg Economics, on the fastest show in politics. I'm Joe Matthew. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all ripping higher right now. The S&P 500 index on track for its longest winning streak in over 20 years. That will be 9 in a row. Right to the numbers here, because the S&P now higher by 91. That is a gain of 1.6%. Dow Industrials up 620 now, up 1.5%. NASDAQ up 324 for the NASDAQ Composite Index, a gain there of just about 1.8%. The 10-year at 4.32%, and on this Jobs Friday, the 2-year 3.83%. Gold now down $8 the ounce, down 0.2%. West Texas Intermediate crude 58.19 a barrel, down 1.8%, and Bitcoin is advancing by 1.3%, 97,718 on a Bitcoin. So the S&P 500 index moving higher, looking at a full recovery from April tariff turbulence. Strong jobs data this morning and progress on international trade talks boosting investor confidence. Right now we have got ExxonMobil shares. They are moving higher, little changed, up by about 0.3% after earnings this morning. Chevron up by 2%. Both companies reporting earnings. Chevron, by the way, saying it will reduce share buybacks. ExxonMobil sticking to its buyback plans. And the headline that we brought you earlier bears repeating, certainly driving sentiment today. Beijing weighing a fentanyl offer to the U.S. to start trade talks. That according to the Wall Street Journal. We got you covered on trade. The Dow, the S&P, NASDAQ all higher. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. And Balance of Power continues now. Back we go to Washington, the Friday edition. He made it. Here he is, Joe Matthew.
You made it too, Charlie Pellet. Thank you so much. And it's a pretty good day on the markets. We'll get back to Charlie shortly with that Beijing headline resonating on Wall Street. Maybe we'll learn more from the White House on this. It really did seem to kick in the afterburner right around noontime when we came to air and that headline broke on the terminal. Interesting Friday trade here on what is, of course, Jobs Day as well, having discussed that with Stuart Paul. For our audience in Boston on 92.9, interesting to see the Truth Social post from President Trump, because this has been a week. We're going to be taking away Harvard's tax-exempt status, he writes. It's what they deserve. This is something that has been floated by the president before, and now he says the administration is actually going for it, having spent weeks teasing this idea, and of course already moving to revoke federal funding at Harvard, setting up quite the standoff and the battle between the two. But can we just pull back here for 1 minute on this Friday? It's the 2nd of May. And if you go back to where we were Monday, you probably wouldn't even recognize the political world. That's how often and how dramatically things change around here. As we look at a stock market now round tripping all the way back to where it was before Liberation Day. I haven't even mentioned Mike Waltz yet. Haven't mentioned Pete Hegseth. So Wendy Benjaminson walks in the room here, and I can say this because we're all friends. Our senior Washington editor sits down and says, "Has anything changed in the last 10 minutes?" Because that's the news cycle we're in, isn't it?
It is.
And you have to edit
I
this
said
stuff.
10 seconds.
Seconds? Yeah, exactly. Yeah. Exactly. Before we get into Harvard, unpacking and cataloging these weeks, it's become, I guess, a futile exercise. But we've cleared the first 100 days, and I wonder what kind of context you can put around what we've seen just in the last 5 days.
That there is absolutely no slowing down. There is no deceleration of this frenetic pace. And we all sort of hoped maybe that he had said he would get a lot done in the 100 days, most consequential 100 days in American history, right. He says. And then we thought, okay, so he'd take a breath, do what he's doing this weekend, which is 3 days of golfing in Mar-a-Lago, and we could all...
Yes.
But he still has his phone, and he still has Truth Social. So we do not get a 3-day golf weekend.
Well, no, that's true.
Yeah.
How worried should Harvard be about this? Or is this, it's politically good for Donald Trump and easy for him to say it. Could he do it?
Sure. Maybe. He also could be fresh off that University of Alabama commencement speech where he said this future will not be decided by the Harvard Crimson. It'll be decided by you, the Crimson Tide, which was an interesting turn of phrase. But he's clearly saying it's not those snooty elites in New England. Right. It is you real people in the South sort of thing that will, rise up. The tense of these posts is what's interesting. We will be revoking the status. It is not something he can do by executive order. It can take years for the IRS to get through that and or the court challenges. And I read something fascinating this morning in the New York Times, which I'll share. Bob Jones University in 1976 had its tax-exempt status threatened by the IRS because of some discriminatory policy. This stayed in the courts until 1983. They lost their tax-exempt status then, dropped the discriminatory policy in 2000, and got their tax-exempt status back like a few years after that. 1976 that started. So, and then it took till 83 to actually happen. So we're looking at years beyond. By the time the IRS investigates, by the time the IRS, I mean, clearly Trump gave a wink nod to the IRS commissioner that you ought to do this, but it's not the stroke of a Sharpie.
Sure.
Yeah.
You know, the president frequently says, I was elected to do the things that I'm doing, when he talks about tariff policy, when he talks about extending the Trump tax cuts, when he talks about closing the border. To what extent was he elected to wage a culture war?
In large part, he was elected.
Was that as big as any of the other things I mentioned?
Absolutely. How many times did he talk about anti-Semitism on college campuses, or what he perceived as anti-Semitism, DEI, transgender bans, all these sort of things that were the punchlines at the rallies. They were the guaranteed applause lines. And so he felt certainly empowered to do all of that. The trouble is he keeps bumping into the Constitution and courts, even his own appointed judges, which really irritates him when a judge that he appointed finds something illegal in his activities, like the one he appointed who said, no, you can't use the Enemies Alien Act to deport Venezuelans without due process. And that really sticks in his craw. But, you know, that he absolutely was elected to do these things. I think there are some, as prices go up, people will see this as, but you promised to bring inflation down. And so that may be where the rubber meets the road.
Well, it's interesting because Democrats don't seem to know what to do right now. We're going to talk a little bit later on with Mallory McMorrow, which is a conversation we've been looking forward to as someone who's been framed as a rising star in the party with maybe a different nuance in message. But you saw this attempt in the Senate a couple of days ago to try to codify the congressional authority over tariffs to condemn what the president was doing. Couldn't even pass. 49-49. Sheldon Whitehouse is in South Korea. So J.D. Vance gets in the car to cast the tie-breaking vote. It's going nowhere in the House anyway. I mean, beyond symbolic gestures like this, are Democrats out of business?
I don't know if they're out of business because Trump may be his own worst enemy in the end, but the Democrats have not yet figured out, despite hours of navel-gazing, despite hours of discussions, they can't quite seem to find that thing that will work. I mean, Kamala Harris gave a speech the other day or sometime over the last week in which she again talked about how awful Trump is. She lost the presidency. They lost the presidential campaign because her only message was, Trump is awful, I'm better. But Democrats have not yet found a winning message to win back the working class, the middle class, and people who feel that the economy and the Democrats and Republicans have left them behind.
Well, it's an interesting situation. You talk about the difference between these constituencies, specific to tariffs. I'll just stick with the Mallory McMorrow example, running for Senate in Michigan now. You've got people in C-suites at auto companies who are very upset about tariffs, but you've got people on the manufacturing floor, the auto workers, love it. How does a Democrat run in that environment?
That's very tricky, but I think they can point out that this is how a Democrat would win. I'm not necessarily endorsing this, but prices are going to go up, and back-to-school shopping doesn't seem that far away right now. And when the clothes at Walmart and Target that auto workers might buy them from, even at the Gap or,
so you
other
think
more
they
expensive.
Find religion on tariffs
I think
when reality hits.
Yeah, I think they might because they're not getting the reshoring. Voters want instant results. And that was one of the problems with the Inflation Reduction Act. You are now seeing construction all over the country that says, funding by the Inflation Reduction Act. But that was then, and they want instant results. And so if they even if they think they're going to get these reshoring, this manufacturing jobs back, and yet then they have to buy their kids clothes and they cost 75% more or 100% more, then I think there might be a political consequence for the Republicans.
Well, the president said it out loud this week. You know, you might have $2 instead of $30 this year. Yeah, you might pay a couple of extra dollars. Was that the biggest political blunder of his tenure in this White House so far?
It was a big one.
They're going to play that back all year.
Well, if Democrats have a good strategy, I would suggest they play that back
already, right?
Well, one would hope so. I mean, that's just it. It was such a let them eat cake moment. I mean, Bessent or Lutnick, I don't want to tag, I don't know exactly who said this, but one of his cabinet members was like, so you'll pay a little more. What's the big deal? And if you're a billionaire, it wouldn't be an inconvenience. To upper middle class people, it's an inconvenience. To most of America, it is the decision between buying that or not buying that and doing without. And the $2 versus 30, I challenge a young woman not named Ivanka Trump who had $30 growing up.
Up here.
Yeah.
But that's also the peril of speaking publicly. It's pitched as a strength for this president.
Often
he
is.
gives 3 hours a day live at the Improv. Joe Biden wouldn't do that. But at some point, you're going to say something that you might regret. At some point, you might say everything out loud.
Right. And that's what he did in that
So what does that
moment.
mean for the next 100 days?
Well, it just means, I mean, the markets have begun to calm down now that China has said, okay, maybe we can talk, tell us what you want on fentanyl and we'll have a conversation. That calmed the markets down, which calms down people's retirement accounts, calms down that. But it is the prices. Everyone goes to the grocery store and goes to Walmart and Target to buy their kids' clothes and toys, and that's gonna come home to roost.
Interesting. Yeah, all of this stuff, there's just, it's a matter of time, I guess, before, as we were discussing earlier, the soft data starts to come through in the hard data. We've got a Fed meeting next week. You wouldn't want to be Jay Powell right now, would you?
I wouldn't want to be Jay Powell.
It's going to get questions about Donald Trump and tariffs for that entire news conference because nobody's expecting a change in rates.
Right. And no one has signaled a change in rates for months to come. It'll be midsummer at the earliest. And that's only if inflation and the unemployment numbers change. And so far they have been okay. They have to see real change, and then there's a delay, right? They can't just do it instantly.
We're pretty much out of time here, Wendy. You mentioned the headline about China, though. Is Donald Trump simply waiting for an off-ramp? Did he just get that?
He might have. I mean, the Chinese have been, saying, no, we're not going to talk until you show us some interest in talking. And now they feel that they've gotten enough of a nudge to give them political cover for their own constituencies to come and talk to them.
Well, you wonder if the off-ramp presents itself, if he, in fact, will take it. And we might find that out together in the days ahead. Wendy Benjaminson, Bloomberg senior editor, bringing a sense of humor and grace to our Friday conversation. We always look forward to it, Wendy. Thank you so much. I'm Joe Matthew in Washington. The conversation that I mentioned, Mallory McMorrow, is straight ahead. We'll have Kaylee Lyons join us coming up, so stay right here on the fastest show in politics. This is Bloomberg.
9:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks continue to push higher. We have got the Dow, the S&P, NASDAQ all gaining. Best level of the session right now on the S&P, right to the numbers, up 92. That is a gain of 1.6%. Dow Industrials up 621, higher by 1.5%. And NASDAQ up 333, now higher by 1.9%. S&P, by the way, on track for its 9th day of gains, longest winning streak if you're keeping track, and yes, we are here at Bloomberg, in over 20 years. Today's rally driven by strong jobs data and progress on international trade talks. Again, the S&P keeping it all in context, up 1.6%. 10-year at 4.32%, with a 2-year currently yielding 3.83%. Spot gold down $7 the ounce, a drop now of 0.2%, 32.32 on the precious metal. West Texas Intermediate crude down 1.5%, 58.33 a barrel, and Bitcoin now down by 1.2%, 97,579 on a Bitcoin. Fresh data today on manufacturing as tariffs loom over the economy. And with that story, here's Bloomberg's Vinny Del Giudice.
The government's data are lackluster at best. Factory employment dipped in April, though the overall U.S. economy added jobs. Factory orders for business equipment in the meantime barely budged. Total orders were up, though, led by aircraft. The reports follow Thursday's disappointing numbers from the Institute for Supply Management. The ISM said factory output posted the biggest drop in 5 years in April. Vinny Del Giudice, Bloomberg Radio.
Take-Two Interactive shares down 5.6% as the gaming company pushes back the release of the next Grand Theft Auto version to next year. Again, Take-Two lower by 5.6%. And shares of Block Inc. are plunging the most in more than 5 years after the digital payments company that's led by Jack Dorsey posted first quarter results below analyst estimates. Right now, we've got shares of Block down by 20.8%. Ticker, by the way, XYZ. Recapping, S&P up now by 1.6%. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. Live in New York, Charlie Pellet, the voice of Wall Street and the New York subway, with us here on the fastest show in politics. Quite the rise in the markets here following that headline of less than an hour ago coming from the Wall Street Journal about an overture from Beijing when it comes to trade, one of the president's most important issues, not just trade and tariffs, but also fentanyl, maybe an off-ramp here from China, according to the Wall Street Journal. Wall Street is not waiting around to find out, with new highs for the day. With us now, a little bit earlier than usual, is my partner, Kaylee Lines, here on Balance of Power for an important conversation that we're going to have with Mallory McMorrow. It's been an interesting day here in news, though, coming off the data this morning, the news from China. Maybe we'll get some more clarity on this. I think it was Kevin Hassett yesterday who said there was trade news coming. We didn't get it yesterday, but that doesn't mean it can't happen on Friday.
Yeah, so they keep us waiting. And of course, this news from the Journal comes after the Chinese Ministry of Commerce signaled that it is evaluating whether or not to open talks with the United States on trade overall. But the fact that this reporting suggests they're looking at fentanyl specifically speaks to the very myriad range of issues that the U.S. is using tariffs to address with China. It is not just about their overcapacity in terms of supplying the global markets and what he sees as a way too large trade deficit. It's also about things like fentanyl. And as we always have, it's a question of how much tariffs are intended to address those issues, or how much it is about onshoring U.S. manufacturing, benefiting American workers, because that was the argument, of course, he was making as he celebrated 100 days in office in Michigan last week.
That's right. Well, it brings us to the dichotomy that we were talking about a little bit earlier this hour. And Michigan is a great example of that when it comes to auto tariffs, for instance. In the C-suites, and we've heard from Mary Barra, we've heard from the executives at all of the major U.S. automakers. Jim Farley certainly had strong feelings about tariffs. This is a massive disruption in their supply chains and potentially in their business. They're pulling guidance. But when you talk to auto workers on the manufacturing floor, they love this idea. And many of them voted for Donald Trump.
Yeah, that's right. Sean Fain, who leads the United Auto Workers, has been wholly supportive of the idea of auto tariffs specifically. And it becomes a question of, is it something that is different for the companies than it is for the workers who are actually putting together these cars? And of course, that is a key constituency in states like Michigan.
Well, this is the backdrop for our conversation that we've been looking forward to and telling you about. Mallory McMorrow is with us, Democratic Michigan state senator, and now a candidate for U.S. Senate, having been framed repeatedly as a rising star in the Democratic Party. Mallory McMorrow, welcome to Bloomberg. It's great to have you with us. As we have this conversation about trade and tariffs specific to Michigan, just want to ask you more broadly. This past election saw Michigan elect Elissa Slotkin and Donald Trump on the same ballot. When we consider the message that you're honing now as a new generation on the campaign trail, what is it that national Democrats misunderstand about your state?
Michiganders are fiercely independent, and it's so great to be with both of you to share a little bit more of why. You know, this is a state that in the 1980s had 5 of the top 10 metro regions in the entire country for median household income. So this idea, this vision of Make America Great Again, I think was compelling to a lot of Michiganders who remember vividly when we were the most prosperous state in the country. And there is a longing to recapture that prosperity. And the question is how? So I think that is a reason why many Michiganders may have voted for Donald Trump, but also see the appeal in somebody like Elissa Slotkin, somebody who is no BS. She will tell it to you straight. She brings a strong national security background with her work in the CIA. And I think a lot of Michiganders respect the fact that Elissa served under both Presidents Bush and Obama. In a moment where we see nothing but division, people want to see their elected leaders work together. So my campaign is really centered on this idea of making a new American dream, acknowledging that we can't recreate the prosperity of our past by going backwards, and leaning into my own story. I'm a millennial who graduated right into the recession. I had no job prospects. I had no health insurance. I lived in the back of my car for a few nights, applied to 300 jobs, and I talked to Michiganders across this state who share that sentiment and frustration of having done everything right and still feeling like they're behind and they're not getting ahead and they don't have stability. So this is going to be about 3 things: success, safety, and sanity, and writing that new American dream together in a way that people can see themselves in, that isn't just about Donald Trump. It's not about, relitigating what he's doing or not doing. It's about what our future looks like.
Well, and we do want to get into the fact that you are a millennial and kind of the generational question now at play with the Democratic Party and what you might represent. But to touch back on your point around prosperity and what it will take to return it, for those who were gathered at the rally in Macomb County earlier this week, as Donald Trump talked about the Reagan Democrats and the auto workers who he thinks his policies will benefit, what is your message to that particular part of Michigan's constituency that you are seeking to represent, who feel like these policies actually would serve to benefit them?
There is a world where a thoughtful trade policy, thoughtful tariff policy could do things like bring a 3rd or 4th shift back on some of our manufacturing facilities that have laid workers off or have idled. But what we're seeing now is the broad, expansive tariffs that went on after the announcement of the auto tariffs on everyday goods, from clothes to coffee to bananas to diapers, is going to devastate workers. So the approach that I have, that I hope Michiganders hear, is that we have to be thoughtful as we put policy forward and not have this approach that I think we've seen out of the Trump administration of ready, fire, aim, of let's just announce things, see how they go. And I think Michigan, really for the rest of the country, is a canary in the coal mine. We saw some strong jobs numbers come out this morning. However, Michigan has the 2nd highest increase in unemployment in the entire country. Our unemployment rate is sitting right now around 5.5%. We've seen layoffs at Stellantis, at suppliers, at small business owners, and we see that ripple effect play out where, over in Long Beach, the longshoremen put out a really critical, strong letter about the impact that this is going to have to jobs in the economy if we don't see some measuring in the approach to tariff policy. So I am heartened by some of the news out of Beijing that you just mentioned, but we're going to have to see some stability and not the chaos that we've seen so far.
There's a question about whether